Is my screen visible?
Okay.
Yes, it is.
All right. So we look at intangible assets. Now, when we talk about intangible assets, in financial accounting or financial reporting, we said that these are what? Identifiable non-monetary assets without physical substance, right? That are being used or that are used for production and supply of goods and services for administrative purposes and, if idle, even for rentals. Is that okay? So it means that for intangible assets, you cannot see, you cannot touch them, but they have value. Does that make sense? And because they cannot be seen and touched, they create a lot of loopholes in tax planning. Is that okay? So we have something we call intangible asset migrations. And intangible asset migrations is what is causing the revenue authorities to lose a lot of cash. I said intangible asset what? Migration. Okay. So this intangible assets migration causes the revenue authorities to lose a lot of cash. And that is why we have to understand intangible assets for transfer pricing what? Purposes. Are we okay? Now, under the transfer pricing guidelines, an intangible asset is something which is not what? A physical asset or a financial asset. Are you getting it? So, physical asset, you cannot see it. Okay, now it's capable of being owned or controlled for use in commercial activities. Okay, and their use or transfer will be compensated between independent parties under comparable circumstances. So the whole thing about the arm's length principle and transfer pricing is that whatever you are doing, one independent party do the same thing under comparable conditions or comparable circumstances. So that is what we are really what looking at under transfer pricing. So, unlike other accounting definitions, transfer pricing focuses on the economic value and not merely the legal recognition. This is because under tax planning, we consider the commercial substance over the legal form. All right. So, what is the characteristics of intangible assets? Now, an intangible asset generally has the following characteristics: they have no physical form, they should provide some sort of future economic benefits to the person. It should be able to be transferred or licensed. It should create commercial value. It must be legally protected. Otherwise, people can easily copy. And independent parties would ordinarily pay for it too. So if I say I have a patent and nobody will be willing to pay for it, it doesn't qualify as an intangible asset in transfer or under transfer pricing purposes. Does it make sense? Does it make sense? So it doesn't have a
Yes.
physical form. It should be able to provide future economic benefits to the people involved. It should be able to be transferred or licensed. I get it. It should create commercial value. It must be legally protected. Independent parties should ordinarily pay for the use of that intangible asset, right? So, what are examples of intangible assets that there are? So, we have two main types of intangible assets, okay, which can be what we call marketing intangibles and trade intangibles. So the marketing intangibles are the ones that allow you to market or the ones that help you to market out there. And these ones derive their value from marketing activities like trademarks, trade names, your brand name, your customer list, your distribution network, your domain names. Now, these are things that put you out there. So we call them marketing intangibles. Does that make sense? Does that make sense?
Yes, sir.
Yeah, so the things that make companies go out there through their trademark, like Coca-Cola, they have a trademark, right? Some people have brand names. All these things are intangible assets. Okay, then we have trade intangibles. These are the things that help you to produce or give some sort of service. It's not necessarily about marketing. Like if you have a patent, you have a copyright. People cannot copy and use your product, right? Manufacturing processes, technical know-how. If you have a proprietary software, right? If I make a software and people copy, I get it. That's a trade intangible. I can sue them, right? If you have secret formulas or industrial designs, I get it. Then we have other commercial intangibles, like when you have a franchise, a license, a government permit, a database of customer relationships, exclusive distribution rights. I get it. So you can say that we basically have what trade and marketing intangibles, but we can have other commercial intangibles as well. I get in a way fall in between, but sometimes these ones we also put them depending on the nature under marketing or trade intangibles. Please, are we okay? Are we
Yes,
okay? Now,
yes.
under the
Yes, sir.
OECD flow, is it yes or no? Yes, sir.
Yes.
Yes.
Okay. Now, there are some assets that are not intangible assets for transfer pricing purposes, right? But they may influence value. Like if the group gets some sort of synergies, okay? So if the group is getting some benefits because of what one or two or more of the group members are doing, yes, even though it brings a value and you cannot easily measure it, it doesn't constitute intangible asset. Also, market conditions. You can have favorable market conditions in your market that is generating you a lot of profit. That doesn't mean it's an intangible asset. Okay, then we have market share. So your market share is not something you can sell to somebody. Do you get the idea? Business opportunities are not intangible asset, and the workforce itself, unless you can transfer the staff. So, for instance, my workers who are working for me, if they are really doing well and the business is boosting, can I sell them for money? Can you sell your staff for money?
No.
No, so they don't constitute intangible assets. Your internally generated goodwill. Yes, you have the goodwill, long customer relationships and stuff, but you cannot sell it. So when you look at the IFRS, particularly IAS 38, it says that an intangible asset is an identifiable asset, meaning that you can separate it from the business, okay, or it can arise out of a contract. If it doesn't meet that criteria, it means there's no control. And locational savings, these things are just comparability factors. Please. Eh? Oh, you have just disrupted the flow right now. Oh, Charlie. So we have locational savings. These are just comparability factors, just rather than what intangible. So these things are not intangible assets. So remember. Please, are we okay?
Yes, sir.
Okay, so when it comes to intangible assets in transfer pricing, right? What this is the difficult part of transfer pricing, but I am going to break it down for you to understand really well. Look, let me just please don't joke with intangible assets. You see the things we did in these past few days. You don't take them serious and see. What's your best, you know? Because I've realized that students immediately you say transfer pricing, they're only concerned about the calculation. But transfer pricing is not really about the calculation. It's what you use the calculations to do. Do you understand? Does it make sense? Does it make sense? Now let's look at a scenario here. This is party A in the US. Are you getting it? This is the group. So party A in the US, look at what it is. So let's say this is the parent company. This parent company transfers a franchise, right? Transfers a franchise right to one of the entities in what? Mauritius. Are you getting the idea? And then this guy also transfers what? A part of the franchise rights to a company here in Ghana. These are all three companies, right? Parent, subsidiary, and another subsidiary. Now, if this guy starts paying royalties, he pays the royalties to the guy in Mauritius. True or false? True or false?
True.
True. But who is actually getting the benefits of the royalties? Who is the original owner? Who is the original?
Country in US.
Yes, the parent company in the US. But because US does not have any DTA, you see how he's doing this thing. So if you look at it, the legal form is that the franchise in Ghana, who owns it? It is the Mauritius company. Okay? So this is the legal form. But the commercial form of it, or the economic ownership, is with this guy, the beneficial owner. Okay, which is the guy here. So this guy is the beneficial owner, the one who actually owns all the benefits from the franchise. So the actual royalties come here to this guy. And with intangible asset, this is the thing that can happen, and it will mask the true source of the ownership, where the tax authorities cannot see. That is why you have to really understand economic ownership. We are concerned about economic ownership and not legal ownership. Is that clear? So let's understand it. Now, legal ownership belongs to the person whose name appears on the legal registration or the title. So, on the face of that franchise, or on the face of shares that are bought, I get it. The person who sees the registered patent owner, the trademark registrant, or the copyright holder, right? But he's not the actual person benefit from the risk and rewards of ownership. If I give a distribution van to my brother, okay, and I am the one who has the document to the cars, right? The ownership document of the car. I am the one who has it. But at the end of the day, who is using it? It's my brother. If it gets spoiled, he's using it to make money and those things. That's economic ownership. The legal ownership is that what? This thing is with me. Does it make sense? I am the owner, it's with me. But then who benefit from the use of that thing? It's my brother. Do you get it? The economic benefits. Does it make sense?
Yes.
Yeah.
So legal ownership alone does not entitle an entity to all the income generated by that intangible asset, but only part, right? Because you are just the legal owner. Now, when it comes to economic ownership, it belongs to the entity that performs, controls, and bears the economic significant functions, assets, and risks that relate to the intangible asset. So, economic ownership determines the entitlement to returns from that intangible asset. For instance, if the parent company holds the title to a patent, but the subsidiary is the one developing the technology, funding the research, bearing the development risk, and improving the patent, who should get the benefit from that patent? Is it the parent or the subsidiary? Who should get a lot of
The
benefits?
subsidiary.
Parents.
Subs- Hey, please look at it. I said if the parent holds the legal title, meaning your name is just on the patent, but it's a subsidiary who developed the technology, he funded the research, he bears all the development risk, he improves the patent. Who should get all the benefits or majority of the benefits?
The
The
subsidiary.
subsidiary.
It's the subsidiary, not the payment. Not the parent. You understand? So the person who said parent, note, is the person who does the DEMP. Okay. The one who uses this, who performs a function, uses assets to perform and bear risk, because the higher the risk, the higher the returns. Is it clear? So although the parent is a legal owner, the subsidiary may be what entitled to only a part of or all of the economic return because of his contributions. Do you understand? And this is what you have to understand for intangible asset. Now, let's understand DEMP analysis. To understand intangible assets in transfer pricing, meaning you must understand DEMP very, very well. Now, the OECD introduced the DEMP framework to determine which entities are entitled to what? To returns from an intangible asset. So it is also, DEMP is also a functional analysis. I know most of you already know what we mean by functional analysis. So when it comes to intangible assets, the functional analysis is what DEMP is. Are we okay? So DEMP stands for development, enhancement, maintenance, protection, and exploitation. So who develops it, who enhances it, who maintains it, who protects it, and who uses it or exploits it? The one who does majority of these things is the one who gets a lot of returns. Are you getting it? So the returns from an intangible should follow the entities performing and controlling what these functions. Are we okay? Good. So let's understand them one by one. Then we take an actual question to see whether you can actually understand what is going on. So when we talk about development, these are activities involved in creating that intangible asset. Okay. So the function that can be performed may be research, maybe product design, software development, innovation, the things that you actually do to develop that asset. Do you understand? When we talk about enhancement, we are looking at activities that improve the value or the functionality of an intangible asset that already existed. So maybe I'm doing product upgrades, I'm bringing improved software versions, I'm doing brand expansion. Okay. So these things are just enhancing the value of the intangible asset. Enhancement, just ODBB can organish man IFA. Do you understand what that means? Then we come to maintenance. Maintenance is where you preserve the value of the intangible asset. So, example, when you are doing routine software updates, okay, you are doing trademark renewals, you are doing brand management just to maintain the value of the intangible. One, you are enhancing the value is enhancement, but here you are making sure you sustain whatever you enhanced. Does it make sense? Then we have protection. Protection of intangibles has to do with what? Safeguarding the legal rights for that particular intangible. So, example, when you are doing patent registration or enforcing trademark, or if there are some what where you look at the processes for what suing people who infringe upon the intangible. Then we have exploitation, how you generate income. Okay, so exploitation has to do with generating income. Okay, and this has to do with what things like licensing, franchising, or doing commercial production and royalty collection. So we are saying that the entity performing and controlling the DEMPI functions receive an appropriate share of the economic return. A legal owner that merely holds title but performs no DEMPI function is generally entitled to only a routine return for funding or ownership. So usually, the parent company who just owns the legal title, right, only gets a routine return. Let's say that I am the one who owns it. So you guys look at it. If I own a firm or a company, right, that maybe kills animals to sell, okay, yes, I own it. So if let's say we get a contract to maybe butcher the cow and do kebab and use it for wedding, okay, one, they are going to give me a share of the money based on maybe the 100 million that came in, right? But then the people who did the butchering and the packaging and those things, apart from the routine, the normal contribution they are going to give them, right? For the extra work they did, are you getting it? Which is the DEMPI, they should get something extra. Do you get it? And this is where the profit split comes in. So intangibles, unique intangibles require you to use the profit split method. And I'll teach you how to apportion the routine return and the what? The residual contribution. Do you understand? I hope it makes sense. So always routine return means that the routine functions that you are doing. Are you getting it? You get a return for it. But if somebody is contributing something unique through the DEMPI, he should get something extra. Does it make sense? Does it make sense? So at a higher the risk, if I take more risk, I should get more return. That's simply what it is. I hope that is clear. So OECD is more concerned about your control over risk. Now, the OECD emphasizes that merely providing funds is not sufficient. To earn returns associated with an intangible asset, you must exercise decision-making authority, control the significant risk, or have the capability to manage those risks. Okay, it's not only about exercising decision-making authority. You should be able to control the risks that come or have the capability to manage those risks. Okay, so if you provide funds without controlling risk, you, the funder, generally only earns a risk-adjusted financing return, which is normally a routine what? Return. Okay. Now, the last thing I want to talk about before we look at the values, how to value intangible assets, is what? How to value intangible assets. Okay, so sometimes there are intangible assets for which at the time you are transferring, you can't get comparable transactions anywhere. And their cash flows are highly uncertain. So it's possible the examiner can ask you what are hard to value what? Intangible assets. What did I say were hard to value intangible assets? I said these are intangible assets that at the time you wanted to transfer them, you can't get any comparable transactions to price. Are you getting it? And then the incomes, intangibles, mostly we discount the cash flows. Are you getting it? And get a value today. But the cash flows are highly uncertain. You don't know how much cash flows you are going to get from them. Do you get it? So it's difficult to value them. So examples can be new pharmaceutical patents, innovative software, like early stage artificial intelligence technology, the AI we are seeing now, biotechnology products. They are difficult to value because some has never been there before. And are there a bit new before? No. Do you know it will be difficult to value? Do you all agree? Something that has never been done, wouldn't it be difficult to value them? Very difficult. No, be so. Because some never did before. You understand? Good. So with the OECD approach, it says that the tax authorities may use what we call ex post outcomes. So after we transfer, what came out of it? Based on that result, we can use it to compare to other similar occurrences that have happened. Then we use it to value the intangible asset. Okay, so these ex post outcomes can become evidence that will be used to assess whether the original pricing was at arm's length. I get it. Unless the taxpayer can justify the assumptions that they made at the particular valuation date. I hope that makes sense. So with how to value intangibles, it's difficult to get a price today. But what can happen is that you can transfer it at a particular price, let what happens, right? Then we compare to situations that have happened before and see whether independent parties would have done that. So based on that, we can say that, okay, the price is at arm's length. Do you understand? Good. But if you think that whatever you have used, you can apply to GRA and say, you see, the assumptions that I made when I was valuing is this, and I think it's fair. GRA can consider because that thing has never been in the system. Maybe if this is your first one, we can allow you, and then subsequent people who come with something like that, we are now going to use yours as a base to value. Does it make sense? Now, when it comes to intangible assets, the most appropriate transfer pricing method should be the cap method. Okay, only when we have what reliable license agreement or royalty rates exist for us to use as comparables. I get it. So for intangible asset, if I can see something similar to that, then I can use what the cap method for that. Okay, then we use also the profit split method. So we use the profit split when both parties contribute unique intangibles to the particular agreement, right? And the DEMPI functions are shared among the two, and the transactions are highly integrated. So when you see some of these inside a particular case they give you, it tells you that you have to use the profit split method, right? We'll come and do profit split in some few minutes. From here, we'll be going more into comparability and then when to use the transfer pricing methods. Now, transaction net margin method will be appropriate when one party performs only routine functions relating to the intangible. So we mostly, when you are doing profit split, for instance, you still use the transaction net profit margin. I get it, or the transactional net margin. Now, what happens is that you see, you have routine functions and non-routine functions, things you do every day and things that require special contribution. So the things that you do every day, we use transactional net margin to share the profits, right? Then once we are done, whatever unique contribution into the intangibles, we use profit split to share it. Do you understand? So profit split, we have two types. I explained to you yesterday. We have the double stroke and the single stroke. There's a double stroke, or what we call the residual analysis or residual profit split. Now, to value intangible assets, we can use the cost approach, income approach, or market approach. Are you getting it? Now, the income approach is where we discount. That's the same as the discounted cash flow. So this is based on the present value of the expected future income generated by the intangible, right? So the discounted cash flow. So things like patents, brand, software, unless they go into the future before we know the actual benefits. So if we know that, okay, I've given you my software, you are paying royalties. So softwares like Tally, QuickBooks, and the rest, how do they estimate the value of the software? Assuming somebody wants to buy QuickBooks, they look at all their licenses, how much they are taking from the licenses every year. Do you get it? Then they discount it into the next 20 years, for instance. Then they bring it to present value to know exactly how much they will be getting over the years in present value, and that becomes the value of the software before they can sell it to you. Does that make sense? So we use discounted cash flow to discount these cash flows into the present. So assuming somebody has a brand on social media, you want to buy the person, he knows he gets brand deals of 10,000 cedis every month. That brand deals of 10,000 cedis every month, if we accumulate all of them for the next 30 years, I mean, he's young, he's 20 years of age, 30 years as an influencer, by 10,000 cedis per month, and I discount them to present value, that amount I can sell my brand to you. Do you get the idea? Are you following? So the first way I said is the income approach, where we use the discounted cash flows. So we have the market approach, where we use comparable market transactions. So does somebody have that kind of what intangible asset on the market? Do we have comparable license agreements or sales that have taken place like this before? Then let's use what is in the market to price our own. Very simple. Then we have cost approach. Now, the cost approach is where the value is based on the replacement cost. So right now, if I want to replace this intangible asset, I get it. How much would somebody pay for it? Or if I have to reproduce it, how much would I pay for it? I get it. So cost approach, mostly we use it for internally generated intangibles or some other intangibles where it's difficult to get cost information or market information. So the levels I've given you are actually, when you go to IFRS 13, this is like what? It's stages. So if I can't use the discounted cash flow approach, I use the market approach where comparables exist. If I don't have that, I have to now use the cost approach. And cost approach is mostly for internally generated intangibles and routine functions, things that require routine functions, because cost is mostly what? Historical in nature. So it's the less reliable of all of them, but these are how to value intangible assets. I get in it. And sometimes intangibles are bundled together. It's difficult to separate them. Are you getting it? So in summary, we are saying that everything for intangible assets is about economic ownership, not the legal title. The one who has the legal title only gets routine contributions. The one who has what the economic ownership, I get, is the one who gets most of the returns, provided that they are in the DEMPI functions. And we were also saying that intangible assets, are you getting it? There are two types, trade and marketing intangibles, and even other commercial intangibles. Then we went forward to talk about what the DEMPI functions and what they mean. That the higher the risk, the higher the return, right? Then we also said that they are hard to value intangible assets. That at the time you're transferring, you are uncertain about the cash flows, and something like that never existed in the system. So mostly the tax authorities will use ex post outcome. Something should have happened after you transferred it for them to know how to value it. And if you feel like your assumptions that you use in the pricing at the valuation date are worth it, you can explain to the tax authorities. And we also came to say that, okay, intangible assets, the appropriate transfer pricing methods are capped if similar arrangements exist, or transactional net margin method if at least one of the parties contribute to routine functions, and then the profit split approach when it's a unique intangible and both of them contribute to the uniqueness of that intangible asset. Are we okay? And there are definitely no comparables. And we look at the valuation of intangible assets, and we said that we can use three main methods. We can use the market approach, we can use the what? The cost approach, and then the
The
what?
cost approach and
Income
then the
approach.
income approach.
Discounted cash flow.
Which is the income approach. So that is it. So that was all about intangible assets. I know as at now, if I say it like this, it doesn't make sense until we take an actual word question. Are we okay? So let's take an actual word question and let's see. Okay, so that was intra-group services. Let's see, intangible assets. Good. So I hope intangible assets was understood. That's one of the most complex areas of transfer pricing, but this is what you need for your exam. There are other aspects of intangible assets, but I don't think CIT will go that far because those areas are very, very, very not complex per se. You require a lot of work because you have to do research, you have to have a database and other things. So this transfer pricing you are learning on the book, it's even the smallest part. The biggest part of transfer pricing, you need a database, and this database is where you are going to get the comparable information. And the databases are very, very expensive. I mean, royalty range like this, the minimum they charge is like $15,000, and that $15,000. Imagine that database you are going to use to do the transaction is $15,000. How much would you charge the person? So transfer pricing gigs, the least you can charge is mostly like the least $25,000. Some people are taking $80,000, $100,000. So transfer pricing is very, very lucrative. Just that people don't know. That's why it's very complex. All right. So that's just by the way. So international tax can change your life if you don't know. CIT just does a piece of it. Just a piece. All right. So let's go and look at how to identify. You remember the DEMPI functions?
Yes.
Okay, so now we are going to
Yes.
put. Oh, why is it moving like this? Even though I've stopped it, it's still moving. So let's take a case with the DEMPI and let's see if we can actually identify the DEMPI. Are you getting it? So anyone who does more of the DEMPI is the one who should face all the risks. Meboa. And all the rewards. No be so. Good.
Maybe so.
So let's look at this DEMPI question. Okay. So Technova Group is a multinational enterprise that specializes in AI diagnostic systems for hospitals. So the group operates through three entities. So we have Technova Research Limited, which can be found in country A. Now, Technova Research Limited employs 80 AI engineers who develop the Mediscan AI software. So if you are looking at DEMPI, what do we see? Develop the Mediscan AI software.
That's development.
That's development. Thank you. And then what intangible asset are we seeing there? Software. No be so.
Software, AI
Thank you.
software.
So a machine learning diagnostic tool for detecting early stage cancer. Now, TNR holds intangible, the legal intangible property registration. No be so. So intangible registration, no. right? The legal intangible property registration. That means it's protecting the intangible. True or false?
Yeah. True.
Registering with the courts. Are you getting it? Okay. Performing all R&D. So if we do R&D, what is it? Development. No be so. Including
Yeah.
upgrades and algorithm improvement. What are they?
Enhancement.
Enhancement. It bears all the R&D risks and decide which features are developed or commercialized. Developed or commercialized, what is that?
Development.
No,
Exploitation.
exploitation.
Okay.
Thank you. And also bearing all the risk and deciding which features can also be maintenance. No be so. Protection is the legal registration here. Because if you register it legally, it means somebody cannot copy. Do you understand?
Yeah.
This is how you see it in scenario. Now, let's look at Technova Manufacturing Limited. It's in country B. Now, this one manufactures hardware scanners and installs the encrypted versions of the medical software sent by TNR. What is the intangible asset we are dealing with here in this case? What are we dealing with here?
Software.
It is a software. Now, the software is TNR who produces it and then gives it to what? TNM. Then TNM will now put it on the hardware. Are you getting it? And they only use encrypted versions sent by TNR. It means that TNM has no access to the source code. He cannot modify the software. He only operates under strict manufacturing contract. It means that this guy, which of the DMP is he doing? Does he do anything to the software? No, look at it carefully. Does he have anything to do to the software?
No.
No, TNM has nothing to do.
Yes, he doesn't do anything to the software. All he does is what? Install the software on his hardware. He cannot get the source code. He cannot modify the software. He operates under strict manufacturing contracts. Does that make sense?
Yes.
Good. So does he have any of the DMP?
Yes, protection.
No development, no enhancement, no
Nothing.
protection, exploitation.
But does it make sense? Okay, now let's look at Technova Sales and Services, right? Now, country C. Now, this one manages marketing, hospital relationships, after sales support, and collects customer feedback reported to TNR. TNS has no authority to modify or upgrade Mediscan. So this one too has no authority. But the only thing we can say is that because they are managing the marketing, they are maybe commercializing it. They are actually using it and selling and getting customer feedback. So we can say that TNS somewhat enjoy some of the exploitation. Can you get it? Because it's like no you see or tone unya customer feedbacks. Do you get it? But they can't modify or update the software, so they have no control. Now, during regulatory testing of Mediscan Pro, an advanced version, authorities discovered algorithmic misclassifications using incorrect diagnostic result. TNS incurred 3 million in recall and replacement costs, and TNR denies liability, blaming incorrect installation by TNM. TNM denies liability as well, stating it followed encrypted instructions from TNR with no ability to modify the algorithm. So, with what has happened, who do you think should actually bear this 3 million? Is it TNR, TNM, or TNS?
TNR.
Why?
Because classification.
Because when
They develop the software.
because the DMP falls on TNR.
They also bear all R&D risk.
Yes. So because they did all the DMP, if the one who is doing the selling, they have told him that they are suing him for $3 million because the software that he brought has given incorrect diagnosis. Okay, so he's going to pay 3 million to recall and replace. That cost should actually be borne by TNR. Why? Because the software, none of them could do anything to it because it came directly from TNR. No be so. But TNR says that he doesn't have any liability, but it was rather TNM who installed it incorrectly. Would you believe this guy? TNM, what is his work? All he does is he put whatever you gave him on a software, on the hardware. True or false? He doesn't do anything.
Maybe there are processes to before installation. Maybe he didn't.
But look at what they said. They said he has no access to the source code. He cannot modify the software in any way, and he operates under strict manufacturing contracts. That means he himself, if he breach, he will have a problem. That means he never breached the contracts.
And
So
there was
this
no
guy is saying that
installation.
he said,
The clause that they gave, they didn't add installation to it.
no, they said he manufactures hardware scanners and installs the encrypted versions. That means you can't do anything to the software. All you do is put it on the hardware. He has no control. So if the software, see, algorithm misclassification, does it have anything to do with hardware? I'm asking you guys.
No, it's software.
That means the hardware had no problem. His work was hardware and putting it on the software. Putting the software on the hardware, and even that one is encrypted. He cannot do anything to it. He can't change anything. It's like you downloading
Just
Microsoft Office
yeah,
and then putting
installing
it on your computer.
you.
Can Microsoft, if Microsoft has a problem and comes to say that, oh, it is this guy who bought my software who installed it wrongly, will you believe? Do you have any control of
No,
them the Microsoft app? No. All you do
no.
is just click the install button. Do you get the idea? So that's what this guy
Yes.
was doing. So he has no liability whatsoever. Everything is on the one doing the DMP. I hope this thing is starting to make sense to you. You see how easy it is? Does that make sense? So the first part of the question said we should identify the key intangibles in the case and explain their importance to Technova. 6 marks. Using the DMP framework, identify which entity performs each function: development, enhancement, maintenance, protection, and exploitation in relation to the medical software. 8 marks. Based on the FAR and DMP, determine which entity should bear the 3 million recall cost with justification using the arm's length principle. And this is 20 marks. I hope the question is well understood. So what intangible assets did we see? 1, we saw the Mediscan software. We also saw R&D. We also saw their brand, or which Technova sales and services was managing. No, be so. Yeah, so 3. We saw 3 in there: the brand, the R&D, and then the Technova, the Mediscan software. Then using the DMP, who performs each function? Everything was on what? On what? TNR. No, be so. So based on the DMP and the functional analysis, who should bear the 3 million recall cost? It is that
Yeah.
guy. Why? Because he's the one who does everything in the DMP, and as a result, he enjoys all the benefits. The same way he should be entitled to all the risks. Do you get it? And that's how you deal with such a question. So the DMP, theory keke. They can actually give you a full question just like this for 20 solid marks. And then they can even ask you, how then do you value the intangibles in the question? How do we value them? We can use what approaches?
Income approach, market approach, and cost approach.
Now now him. Yay.
Say, I
So we
saw
are done
some
with.
solution down there.
You want to look at solution? No, I've
Yes,
thought.
Yes.
let's
Want
I've
look
thought.
at it. Let's look at it.
I've taught you into my phone.
the wedding. How they write.
Oh, say don't do that. Let's look at it. Let's look at
The wedding. No, don't worry. The groom will not come. Wedding, no. Emmaso.
it.
Osi nechigo. Inti wedding ye nya biom.
Oh, say don't
So
do that.
so Prof,
No, the
Prof,
English. The English.
Prof,
Yes, please.
It's a bus.
Prof. So answering it, can you take it country A, then you explain the DMP among them, then you come and take
Yes.
country B
That's why we want to see how they wrote the solution. So
and
that we
C,
know.
then you talk about
Solution no.
the
Solution no ni hugo.
Oh,
Inti no
who was
mamisha answer.
Oh, say.
Solution no nechigo. Inti mamisha answer.
Yeah.
Alright, so let's see. Since you said you wanted to see, let's see. All right. Okay, so what are the key intangibles in the case and their importance? 1, the MedicScan AI diagnostic software, right? So it was a primary intangible asset of the Technova group, a machine learning algorithm that detects early stage cancers from diagnostic scans. We saw it in the case, right? So you just copy and give them. It was created by TNR. and is continuously improved through ongoing R&D, right? So what is its importance? It's the core intellectual property and the main competitive advantage of the group. It drives revenue through hardware, device sales, and associated software services. And hospitals depend on it for accurate diagnostics, which creates strong customer demand and loyalty. So continuous R&D enhancement increases its long-term commercial value, and it is the primary value driver that distinguishes Technova products in the market. So the brand and marketing intangible we saw was also what the TNS marketing activities under the Technova brand, right? And the market recognition of the Mediscan product among hospitals globally. So it brings increased customer trust and adoption of the product, support global commercial expansion, and enhances the exploitation of the technology. You can even bring the R&D that this guy was doing in, right? Because R&D is also an internally generated intangible asset. Okay. So the DEMPI. So one way that I tell people that you should be very smart when it comes to what do we call it? Answering questions, right? Let me just guide you. People don't even know that the questions that they have are 3 different types. So in all my years of teaching, hey, please, who is that?
It's something.
Actually. So we have 3 types of questions, right? That every type of exam, okay, that requires scenarios can ask you. So there are 3 types of questions that you need, especially when we are looking at theory or essay questions, right? So essay questions can come in 3 forms. One, we have what we call answer in scenario type of questions. Okay. So answer in scenario type of question. So with this case that we are looking at, you saw that the answer was in the scenario. Do you get it? So answer in scenario where we saw the DEMPI functions in the scenario itself. Do you remember? And you can pick from there. So let's say this guy, identify whether this guy has a PE in Ghana. You saw that he did this activity, that activity, that activity. It's already in the case. Okay, then we have the next type of question, which is what do you think type of question. Now, with what do you think type of question, what happens is that this one is not necessarily in the scenario, but they are asking you for a suggestion or a particular what recommendation. So this one, you are going to see something somebody has done wrong, and they are going to give a recommendation. So this question we are doing to, you see the next part tell us who should bear the recall cost. Do you remember? So it's what do you think type of question, where you give a suggestion or recommendation. Then we have another type of question, which is knowledge based. So knowledge based is what we call theory. Okay. Knowledge based is what we call what theory. So if you want to learn how to actually answer questions very well, something like international taxation, these are the kind of questions you should be expecting. Either is answer in the scenario, what do you think type of question, or knowledge based questions, which we call theoretical questions. Now, even what is the model I want you to adopt? I want you to remember somebody and his wife, Uncle P and Sister Iwa. What did I say?
Uncle P and
Uncle
Sister
P and
Iowa.
Sister Iowa.
So what is Uncle P? P is point, explanation, and then evidence. That's how you score. So usually the point, which is the heading in the marking scheme, we give this 0.5. Explanation, which is supporting with the law, we give 0.5. And then the evidence, which is the things in the case, that's the application, we give 1 mark. So this gives you a total of 2 marks. All right. I'm also teaching you how to cheat the system. Do you understand? So we are saying that every time you want to deal with a case, let's say, okay, you are taking DEMPI, right? So DEMPI functions. After explaining the DEMPI functions, if you say development, 1, development, that is your point. Does it make sense? Nice heading. Underline it. Then you now start explaining development. Are you getting it? Development involves what? Creation. Are you getting it? Of the intangibles. Are you getting it? The intangible assets, right? R&D, and design processes. For instance, assuming you wrote this, right? This is what? Explanation. Please, are you following? Are you learning something? Are you learning how to actually answer the question? Are you following?
Yes, we are following.
So this is the explanation, right? Then we now come to what? You see what? I didn't put all in one paragraph. I use bullet points. Can you see that? It makes it look very nice. Then you now say from the case, are you getting it? TNR was involved in the development function. Okay, the development function because it designed the software, created and carried out all the R&D functions as well as the algorithms. These functions what? Qualify as development. Now this is what? Evidence. Do you see how to answer questions to score? So 0.5 marks, 0.5 marks, 1 mark. Yay. Understood. Did you learn something? Did you learn something?
Yes,
Yes, Prof.
We get it.
we are following.
Yes. So some of you, do you know, one student, all he will do is that development. Technova is involved in what? Designing of the software. So it's development. You only get 1 mark. We don't answer questions like that. You need to write a proper heading, explain what that thing means, and then now apply it to some particular entity within the case. You are doing PE, okay? You just start now, then you say what? Maybe workshop in Ghana. Then you say ABC has a workshop in Ghana, so it's a PE. No, you say workshop. Then you explain that having a workshop is a fixed place of business at the disposal of what? A company. So that is your point. That's the explanation. Then the evidence is since ABC Limited has a workshop in Ghana, he has a fixed place at his disposal, and therefore this creates a PE. So you must first give us the legal or the explanation, then you now come and give us what? The implication. So it is actually point, explanation, implication, or evidence from the case. And that's how we answer questions if you want to really score high. So the thing now is mindset. It's not necessarily knowledge. You can have all the knowledge. I have people who are even transfer pricing experts and they are still failing international taxation because they don't answer the questions well. But somebody with less knowledge can still go and score as high as 70. But I know most of you are 70 pay 50 plus 1. So these are some of the ways you answer questions to score big. I mean big, right? I don't train people to score small marks unless you are not serious. You don't listen to what I tell you. So anybody who fails through my hand, I tell the person he's not serious. Because if you take whatever I give you, it's enough to help you to pass once. Okay, because I've done it over and over again and I know what works. Okay. Now that was Uncle P. Are we okay with Uncle P? Now, what is Sister Iwa? Sister Iwa is mostly used once Mbappe 17. Sister Iwa is when something has gone wrong in a particular case. So issue, maybe somebody GRA has an issue with somebody, right? That he has a PE. He said he doesn't have a PE. So what was the issue? Why do you think it's an issue? And what action can be taken? That's what we call Sister Iwa. So issue, why is it an issue? And what action can be taken? So somebody is doing anti-fragmentation. So fragmentation in Ghana. Why do you think that this creates a tax liability? You talk about it, right? And then what action can be taken by the authority, by the GRA? or the taxpayer, then you say it. So this is how we deal with Sister Iowa. Hardly do you get questions that are like this, but once in a while they throw them in, and you can apply this model to actually get the marks that are required. Are we okay? So let's go back to what we were saying. I hope that makes sense. Did you learn something? So for instance, if you look at the development, right? After you explain development, you come and take, okay, when it comes to development, you explain development, then who was the responsible entity is TNR, because he employs 80 AI engineers who created the original medical software and its machine learning algorithms, and also carries out the R&D. Then enhancement, you do the same thing. Maintenance, it is TNR. He manages the bug fixes, all that. Then when it comes to protection, it's TNR. Exploitation is primarily TNR, who is supported by TNS. No be so good. So possibly TNR performs all and controls all the DMP functions. So he's therefore the economic owner. That's why I taught you economic ownership and legal ownership. Are you getting it? So if you are doing the functional analysis, who performs what? So when you look at TNR, his functions are that he develops, enhances, and maintains and protects the medical software. Are you getting it? Then he controls algorithm design. The asset he owns is the medical intangible property, and he bears all R&D risks, including software performance, algorithm accuracy, and even the field project. You know how to do functional analysis, right? Then TNM is the one who manufactures the hardware, installs the encrypted software sent by TNR. So he only uses the assets and manufacturing facilities, right? The only risk he can face is operational manufacturing risk only, no control over the software algorithm. Then we have TNS. He does the marketing, the sales, the customer support, reports feedback to TNR. So customer relationships are the particular assets. He has limited commercial and service risk, or only marketing risk, or risk that customers may not pay, right? Liquidity risk, credit risk, and maybe they cannot raise funds, right? So these are the functional analysis. So based on the arm's length principle, are you getting it? Risk should be borne by the entity that controls and manages the risk. So an independent enterprise will only assume a risk if it has the capability to manage that risk and the financial capacity to bear it. So the recall costs arose from algorithm misclassification in the medical software. A software detect defect originating from in the algorithm itself. Applying this to each entity, TNM cannot bear the cost because he received encrypted software with no access to the source code and no ability to modify the algorithm, right? They only follow TNR's instruction. TNS can also bear the cost because they only perform marketing and support functions, right? But TNR must bear the cost because it arose from the AI algorithm, which is TNR's exclusive domain. TNR performs all DMP functions, and TNR bears all R&D risk, including the possibility of failed projects. So an independent software developer who controls the algorithm and bears R&D risk will be liable to indemnify downstream entities for losses arising from software defects. So that's how you deal with such a question. Are we okay?
Yes, please.
Good. Intangible assets go in, is gone.
So we done.
Yes, with intangible
Please, I want
assets.
to ask a question.
Feel free.
Okay. Please, I read somewhere that with the intangible assets, you have to consider the asset utilized. If I started by saying that the functions perform, asset utilized, and the risk assumed. Can you please explain the asset utilized aspect? I don't know
Hey,
if you
this
had
one
talked
I will
about
not,
it.
I will not
I didn't
explain.
join at the start.
I will not explain. If I'm doing manufacturing, what assets do I use to do the manufacturing? Yes, answer me. By all means, I'll need production facilities. Mebwa. I will need people.
Okay.
I would need all those things are assets. That's what we mean by asset utilized. What assets did you use to do that function, and what risk did you bear because you were producing those functions, or you were doing those functions with those assets? That's what we mean by functional analysis. It won't be in the case when they were doing better. For instance, right now I am teaching you, right? What's the function? I'm lecturing you. What asset would I use? A computer, a writing software, a microphone. No, be so. And a software, a
Yes,
Zoom software. True or false? Those are the assets utilized. What are the risks I will incur? Credit risk that people will join my class, they will not pay. 2, internet challenges. You know, so this is a typical functional analysis for what I am doing. Right? Risk of inventory obsolescence. It may be that this software can become archaic anytime and we cannot use Zoom again. Right? Liquidity risk. It could be that I may not have enough money to pay. Right? You get it. This is how it works. And this thing, one I'll be both trimatro, and it's mostly 20 marks, 12 to 20 marks. It's very easy. Do you get it? Sometimes when you read and read and read, then you cast your mind and bring your mind home small and try to digest it and relate it to what you already know. Sometimes too much reading is so bad because you are only focused on the exam. Do you get it? Good. Are you happy now?
Okay.
Are you
Yes,
happy
please.
now?
Thank you.
That's fine.
Very.
Okay, so now we are finished with. Oh, I told you we are working our way up. So we are now going to chapter 3 of the transfer pricing guidelines. We are going to look at comparability analysis. All right. So comparability analysis, there are some steps that you need to understand. Okay. And the steps that you need to go through are very, very important. Okay. So first of all, what happens is that with this kind of steps, what we do is that we conduct a broad-based analysis of the taxpayer circumstance. So if anytime they tell you to prepare a transfer pricing analysis, what you do, or they tell you to prepare a transfer pricing report, the first thing you do is conduct a broad-based analysis of the taxpayer circumstance. So this will involve identifying who the taxpayer is, where he's resident. Are you getting it? Then you select the factors that may trigger transfer pricing risk. That's the same as the things that will trigger a transfer pricing audit. Do you get it? So if there are intragroup royalties and service fees, intragroup funding, year-end adjustment, persistent losses, when there are inconsistent profit or loss patterns, okay, when profit margins are lower than the industry average, I get it. When there's a sudden drop in profit after an expiration of a tax holiday, when there are different prices or markups for similar transactions, or where there's transfer of income or property from lower to higher tax jurisdiction and vice versa. I get it. These things are the things that trigger the transfer pricing risk. Then once you're able to do that, you now identify the transactions from the scenario. When we say identify transactions, we mean that identify the controlled transactions and the uncontrolled transaction. Now, this is also the weakness of students. When we say controlled transactions, you already know what persons in controlled relationships are. Do you remember the associated enterprises or the group entities? Now, any transaction among the group members is considered what? Controlled transaction. Are you getting it? Is that clear?
Yes.
Is it clear? Any transaction among those entities, what we call controlled transaction. But any transaction between the group, one of the group members and external parties or two other external parties is called what?
Uncontrolled.
Uncontrolled transactions. So even the uncontrolled transactions, we have two types. We have the internal uncontrolled transactions, which is between one group member and an external party. I get an independent party, and we have what we call the external comparables. That is what? Two independent parties doing a transaction. So there are always two types of comparables. Either we are comparing what we have, are you getting it? We are comparing what we have against what other people are doing. Are you getting it? Or we compare what we are doing against what I would have done with an external party. Do you get it? So in a case, all you are doing is assuming ABC Limited sells goods to its what do we call it? Its subsidiary, right? The same ABC can also sell the same goods from what? Sell the same goods to third parties, right? Two third parties can also sell to each other. The same way, the one who is buying the goods from ABC can also buy it from another third party. You see how one scenario has split it into different conditions. That's how you identify this controlled transactions and uncontrolled transactions. Look at what I'm saying. So I said, assuming A is selling to another entity who is his sister company B. Do you understand? Let's look at alternatives that can happen. That's how you think in exam. What are the alternatives? A can also sell to third parties. True or false? True or false?
True.
The same way B can also
True.
buy from third parties. True or false?
True.
B can also buy from third parties. No be so. The same way too, another third party can also buy from another third party. True or false? No, be so.
Yes.
So you see how this scenario has created multiple scenarios. In exam, I want you to think like that. So anytime you are doing something, they say identify the controlled and uncontrolled transactions from the scenario. You create it. If one is buying from the other can buy from someone else. You can also sell to someone else. Two someone else's can also buy and sell amongst each other. Do you get it? Makes sense. So once you have been able to do a transaction analysis, the next thing to do is to identify what the tested party. Now, the tested party, usually students have a problem identifying tested party. Now, tested party is mostly used when you are using transfer pricing methods like cost plus, resale price method, or transactional net margin method, right? So selecting the tested party is usually what crucial to the transaction. So the tested party is typically the participant whose operating profit from the control transactions can be most reliably verified with the least adjustment and for which sufficient data on uncontrolled comparables exist. Now, in simple terms, I can say that the tested party is the less complex party to the transaction. What do I mean? Let me give an example for you to identify tested party. Now, look, let's take Samsung, right? Let's take Samsung. Samsung, what does it do? It manufactures and sells phones, right? Let's say manufactures phones. True or false? Now, if I also make a phone called Billy 2.0, I'm also a manufacturer, right? And I want to compare what I have to Samsung, right? I want to compare what I have to Samsung. Then I have my brother, who is maybe Kobe, right? And Kobe also what does distribution. So I am transferring my phone to Kobe at what $1,000, but Samsung sells his phone for $2,000, for instance. If I want to do a functional analysis between these two guys, who should be the tested party? For which of them can I get similar information? For which of these two entities can I get similar information?
I'm fine.
For which of these two entities can I get a manufacturer somewhere to compare to? I can get a distributor. Which one, based on the scenario? Which of them can I get reliable information for?
Samsung,
Is
the
it Billy
manufacturer.
or Combi? Is it Billy or is Kobe? Which one?
Billy.
Billy.
Billy,
Billy.
right? Because Samsung is also a manufacturer. So the external comparable is manufacturing, and I'm also a manufacturer. So I become the tested party. Do you get it? It is for me that I can easily get what a comparable information somewhere. But this guy is into distribution. Did we get any distribution information in the case? No. Do you understand? But what if the same information now Samsung didn't exist, right? But we only had FedEx. We had FedEx or DHL in the case. Who now becomes the tested party?
Kobe.
Kobe. Why? He
Kobe.
does distribution.
Yeah,
He does distribution. FedEx and DHL also do distribution. So we can easily get external data. This is all about tested party. Tested party na nipa na yebenya no comparable information easily on the market. No a resident entity, no on a tested party. And one makes sense. You see, transfer pricing is simple. Okay.
Sir,
So what? Yes, please.
does the tested party always have to be resident?
No, it can be a foreign entity, but it depends on the nature of the arrangement. But mostly look at the resident entity.
Okay.
So once we have been able to do that, right? Mostly we now come and do what? A comparability analysis. So comparability analysis is why when we consider the 5 comparability what factors. Okay, so that 5 comparability factors, Nankasana, they depend on. So let's look at what. That's what we call. So in the exam, they can ask you the factors that determine the financial and commercial relations, right? Are you following? So they can be known as the factors that determine the financial and commercial relations. That's one. Two, they can also be known as the um, basic information, right? They can also be known as the basic information for determination of a transfer price. So they can also be known as the comparability factors. It can also be known as the factors that influence the setting of a transfer price. Or factors that influence factors that influence the application of the arm's length price. Okay, so factors that influence the application of the arm's length price or arm's length principle influence the application of the arm's length principle. Okay, so this is it. Are we okay? So this same thing are all asking for the 5 comparability factors. So this is how they can twist the question. Are we okay? Are you putting it down? Are we okay? So the factors that determine comparability are what? The characteristics of the property or service. The characteristics of the property or what? Or service. Then we have what? The functional analysis, which is the relative importance of the functions, assets, and risks involved, right? Which is the FAR analysis. Then we have the commercial or the contractual terms. Okay, the contractual terms. And then we have the market conditions, or what we call economic circumstances. And then we have what we call the business strategies. Now, these things, do you know what they actually mean? Look, these are the factors that establish comparability. Why? Now, look, assuming that my phone I want to sell, which is the Billy 2.0 that I was talking about, right, was just like the Samsung Galaxy S Ultra. Okay. And this phone that I have is produced by Samsung, right? But it's similar to mine. And then I have decided to transfer it at what? Maybe $2,000 to my brother, but Samsung sells his at $1,500. Okay, so I'm selling to one sister entity. Then the Commissioner General tells you that I want you to price your Billy 2.0 just like Samsung. Is it fair? It's not fair, because we have to make sure that they are comparable in all respects. Do you get it? Before we can what? We can say that, okay, since my phone is equally the same as Samsung Galaxy S Ultra, we shall apply the same prices. Do you get the idea? So first, we look at the characteristics, the physical features. How does it look like? This one is 500 gig. This one too is 500 gig. Do you get it? This one has a SIM slot and a pen. This one has a SIM slot and a pen. So you are comparing. The same way, you can look at Billy and look at Samsung. What functional analysis? Billy is a manufacturer, right? Samsung is also a manufacturer. Good. Do you get the idea? So Samsung also, if you are looking at the assets that Samsung use and Billy use, this guy use production facilities. He will use property, plant, and equipment. He will use human workers, human assets. He will use what design software to design the phone, right? He also needs a brand name. Do you get the idea? Samsung also needs the same thing. And what risk would he assume? Because he is new. Market risk. The market may not accept price volatility. If he's selling to outsiders, right? Foreign exchange risk, inventory obsolescence because it's technology. Do you see how to do a functional analysis? And in your exam, it's best done in a tabular form. What did I say? It's best done in what?
in
In a tabular form. So if you take the entities, are you getting it? You will bring the entities, write their names. Maybe this is what Billy, right? Who becomes the tested what? The tested party. Okay, who becomes the tested party? Then we have what? Maybe Samsung, right? Who is the comparable? And then we have what? Maybe Kobe, who was what? The distributor. Do you get the idea? You get the idea? So when we take functions, what functions? This guy was into manufacturing and design. Do you get it? This guy was also into manufacturing, design, and what? Sales. You get the idea? This guy was only into what? The distribution and sales. You see how you go about it? So it doesn't matter if you can't remember. The one you see, you say it. Now, if this guy is into manufacturing and sales, what assets will he utilize, or what assets will he employ to do the manufacturing and design? One, he will need property, plant, and equipment. Mebwa. He will need brand name. Mebwa. He will need staff or employees. True or false? True or false?
Sure.
Yeah, so you will need human assets, you will need quality control experts. Are you getting it? So these things, are they in the case? They are not in the case, right? So quality control staff, right? Human assets, okay. Technical know-how. Do you get it? So these things, they are not there, but you look at the function that is happening. Design software, okay, and all that. The same thing, you do the same for Samsung. The same things will also be required, right? But this guy does distribution. So what we need? Warehouse to store the goods. Not so. Vehicles, distribution, uh, intangibles, right? You need human workers, right? You also need vehicles for the distribution. True or false? Then what risks will these people face because they are using this asset and performing these functions? Manufacturing. We'll definitely have manufacturing defects. Mewa. True or false? True or false?
True, sir.
True.
So incorrect algorithm, because phone uses algorithm, right? So incorrect algorithms. Market risk, we can face market risk. The good may not be accepted by the market in the first time. You can even face what? Foreign exchange risk. Not so, because you are shipping it to other countries. You can even face so many things, right? Credit risk, customers may not
Credit
pay you
risk.
because you are fresh. Are you getting it? And so on and so forth. Samsung, dear, he's already in the system, right? So what risk Samsung can face may be only forex risk, right? But the other risk, he has been in the system for a long time, right? So people are there, they already have the market. Do you get it? So maybe Samsung will hardly have a manufacturing defect. So based on the risks, this guy too can face accidents. Are you getting it? And other things. Do you get it? So we are saying that if you are able to suggest this in the exam, remember the one who takes the higher risk and also uses what? Premium assets. Do you get the idea? Or assets which are not common is supposed to command what? A premium price. Does that make sense? So if I'm carrying out a very high risk and my assets are premium, then I should charge a premium price. So if Samsung had a brand name which was Samsung's brand name is very expensive. So if Samsung is selling his phone for $5,000 and I'm just a newbie coming into town and I sell mine for $1,000 and the commissioner says I should charge mine the same as Samsung, it is not fair. Why? Because Samsung should sell it higher than mine. because he has a unique brand name that commands a price premium. I am just a small boy. So, Mr. Commissioner, leave me to charge my 1,000 because I can't compare myself to Samsung. Do you get why we do a functional analysis? Does it make sense to you? Does it
Yes,
make
sir.
sense to you?
Yes, yes,
So
sir.
that's why we do functional analysis, to check whether the functions, asset, and risk are similar to the person, because the person who carries on the higher risk should get the higher return, just like the DEMPI, and the one who has premium or unique asset should command the price premium. Makes sense. So this is how we do a functional analysis actually in the exam. It will be better done in a tabular form. So you get. Are we okay now? So that was functional analysis. Now, contractual terms. If you are telling me to price like Samsung, are the contractual terms the same? Do you know that the terms of a contract can even determine the price that should be paid? Two or more people can have the same type of commodity, but the contract may be different. True or false?
True.
Yeah, so the contractual terms can also define what? How much should be paid, the term of the contract, whether they are credits, the volume, everything. Then also the market circumstances or the economic circumstances. Now, these economic circumstances are also, they also determine price. Now, I bought bottled water at Tema, okay, for 5 cedis. I went to East Legon at a pub, right? The same water that I bought as 5 cedis in Tema was sold for 100 cedis. I had no option than to buy the same 5 cedi bottled water for 100 cedis because the spot has gained a particular reputation and people know that it's the big boys who go there. Do you understand? So because of the circumstances in the market, you see, maybe this company is in Tema. He's selling this at 5 cedi. But because this thing can be found in East Legon, they are selling at 100 cedi. So, Mr. Commissioner, because maybe I am located in this part of Ghana, I sell the phone at $1,000. But Samsung is worldwide, right? That's why Samsung is selling at 5,000. You cannot tell me to use Samsung price as my own just because Samsung is an independent party. We must also consider what the market is saying. Does the market accept my commodity? What are the market conditions existing? Do people really accept it? So this is where, in real life, this is where we use what we call the 5 forces analysis, right? Where we look at the bargaining power of customers, the bargaining power of suppliers. We look at what? The threat of substitutes, whether it's easy to enter the industry, industrial analysis. I get it. We look at competitor threats. It's a lot of work, eh? I tell you, this one, what we do in exam is just the surface. We go deeper. Okay, so these things are very easy. I mean, when you get it, you understand, right? You are comparing two things. You must see, maybe this one, you're telling me to sell my Kenke. I should sell Kenke 5 cedis and then rim. No, I'll not do. Or I should sell your Kenke for 3 cedis because in Kumasi, they sell Kenke for 1 cedi 50 pesos. It's not possible. The economic circumstances in Kumasi is different from Tema and Accra. Do you understand? Do you understand?
Yes, sir.
Yes, sir.
Yes, sir.
Aha. So these are the things that determine finally the business strategy. So let me ask you guys this question, right? Now, assuming I start business fresh and then I want to go with low cost or what we call cost leadership. And Samsung has been in the system already. He wants to do maybe risk aversion strategy, right? He doesn't want to go for risk, or maybe he wants to go with product differentiation strategy. Charge higher prices because Samsung is unique. And I am going low cost. Samsung is going differentiation. Do you think we should price the same? Does it make sense to price the same?
No.
No,
Does
no,
it make
sir.
sense to price the same? No, because we all have different strategies in mind. So, Mr. Commissioner, what you are telling me that I should use Samsung's price as mine doesn't make sense. So, I'll not agree with your adjustment. Do you understand? So, when we are even going for objection, for transfer pricing objection, this is what we take and go for the objection. That when we did our critical analysis of the comparability factors that create the financial and commercial relations, they are not similar to Samsung's own. So the price adjustment that the commissioner has done, we will not accept it. And they will look at it critically and say, yes, it makes sense because your business strategies are not the same, your economic circumstances are not the same, your contractual terms are not the same, your functional analysis is similar. I get it, your characteristics are similar, but the other ones are not the same. So we can make reasonably accurate adjustment to make them look similar, right? Then he'll give you a favorable price like 2,000. So that that extra 3,000 that was passed before, they can reject it for you. Do you get the idea? And this is the reason why we do these things. They are very practical. All right. So do you have any question, or you are fine with the comparability factor? So in exam, yes, you create a table and then you work all of these. The ones that you don't know, put not applicable or not enough information. All right, then you are good to go. So once you have been able to do that, you now come and talk about comparability adjustment. No, two things are comparable if they are similar in all material respects, or even if they are not similar. Are you getting it? You can adjust it to make them look similar. So you say that where there's a need for comparability adjustment, you need to what? Do that. Now, after that, you now what? Select the most appropriate transfer pricing method. So selection of the most appropriate method. So I'll use this to teach you the transfer pricing method, Spreco. Do you understand? So understand the most appropriate what? TP method. Now, already yesterday I told you the types of TP methods we have, the traditional methods, and then what? The transactional profit methods. Do you remember?
Yes.
Yes, please.
So let's look at the method and when it should be used. Method and when to use. So in exam, how do you score when the transfer pricing methods come? First of all, you should be able to identify the method, and you should be able to identify when to use that particular word method. And I'll show you the whole trick. Okay, so this is the whole trick about transfer pricing methods. Okay, so it is either you are applying a price, a markup, or a margin. I told you yesterday that the conditions involved can be what? A price. It can be what? A markup. Or it can be what? A margin. Do you understand? So first,
Yes.
before I even come to the methods, we can compare price. One is sold at 2 CD, the other is sold at 3 CD. But 2 CD is what the commissioner says is independent. So we will now apply 2 CD to your transaction. We'll pass 1 CD back to your profit. So a markup is a percentage of cost. Do you understand?
Yes.
A margin is a percentage of selling price. Okay. So if you're applying a markup, it means that you are taking what? Some sort of profit over what? Your total cost. I get 10 times 100. That's how you get a markup. So I'm just teaching you how it should be done. And once you understand this core thing, the thing will become so simple, right? So you are saying that a markup is what? A percentage of cost, meaning you took something over cost. So that profit you got over your what? Your cost times 100, and that gives you your markup. If you want your margin, it's a percentage of selling price, right? That means you are taking some profit over selling price or sales times 100. So markup and margin is what you really need. And most of the time, when there's adequate information, we can get the average markup or margin, right, from the market. I get it. We can get the average from the market where there are independent parties. So if there are 5 independent parties, we can just take an average of their markups and use it for our transaction. So look, assuming I made a profit of 20% on my transaction, but independent parties on the market make 15%, 12%, and 18%. I get it. We can add all this and divide by 3. And what becomes it? What becomes the average markup?
15.
15.
Yes, it becomes 15. You get it. So the midpoint is around 15. So we will disregard. Now the arm's length markup is now what? It's now 15%, right? But I charge 20%. So we will disregard my 20% and say that, okay, if my cost was 10,000, I'm now going to apply what? A markup of 15% on the cost of 10,000. And then now I'm going to get the appropriate selling price. So assuming initially I applied 20%, which made it what? Let's say before I sold it at 12,000, right? But now, if I do this, it means that I should sell at what?
11,500. Oh.
Yeah, I should sell at
True.
11,500, right? I should sell at 11,500, but before I sold at 12,000. So since we now apply the arm's length markup, the commissioner is saying that we should pass an adjustment comparing to the 12,000. An adjustment of 500 will be passed back to my profit, which is a transfer pricing adjustment. So this is how transfer pricing methods actually work. Do you get the idea? We compare yours to what independent parties will do on the market and then find that difference and pass it back to your profit. It's that easy. So now write markup down, write margin down. It will start making sense when we start using it to solve proper questions. Are you getting it? So when we finish the transfer pricing methods, then we close. Then tomorrow we do the last session. Because today I'm very tired. So any question? Any question? Everybody's fine. Everybody is fine.
Yes, please. I'm fine.
So now you know that it's either what a markup or a margin is being used or a price, right? So let's look at the
No,
method and
please,
when
I am not fine.
you are not fine with what?
So when we get that difference and then we add it back to profits, what is the implication,
Not
please?
always add back. That is the implication. You are talking about the implication. You are still asking what is the implication. The commissioner wants your financial statement to look like independent parties on the market. Inti won well overstate profit obekwa kotel profit so that it looks like what it should have been. That's the adjustment. So one understate profit or that adjustment back to your profit, then it looks like what your profit should have been. Then they will tax you on the increased profit.
Okay, thank you.
So you are actually mentioning the implication and you are saying what is the implication. They are all kind of implication. No?
Hello.
So what is?
Please,
Yes,
I want
please.
to ask a question.
Ask.
When they ask you that, what is the transfer pricing implication of a particular transaction? Maybe they'll give you a case and they say, what is the transfer pricing implication? What are they trying to say?
They are asking for the add backs. What would you do under transfer pricing and how do you add back or deduct from profit? That's the adjustment. So far as the thing I overstated profit, it means I should reduce the profit now, right? And because of that, they'll pay tax on the net and any penalties. If I have understated profit, then I'll increase the profit with the excess, which is an arm's length adjustment, which will mean that I'll pay more tax now.
So are we supposed to do the calculation? I'm supposed to write the English?
It depends on whether information was given.
Okay.
Most of the time, even if you do calculation, you say as shown above, then you explain. Never do only calculation and leave it there. You will not get the full mark. You must still explain why you did the calculation the way you did.
Okay.
All right. Are we all okay? Because this implication thing today, 5 people have asked me the implication. And the implication is what we are doing. Transfer pricing implication is the issues in transfer pricing and the adjustment that should be passed. That's what they're asking. I hope it makes sense now.
Yeah.
Is transfer pricing difficult?
It's plenty.
Always is plenty. That plenty cry, I don't know what it is. You have had a lot of time to learn and you are now saying this thing is plenty. If it is plenty, how come I used only yesterday and today to cover it? It's not plenty.
You cover just transfer pricing, but we have the articles and the Income Tax Act and things to learn.
But you should have learned them already.
Oh God.
Whatever I've given you so far is 60 marks. Epa, I will not teach again. Just relying on that can give you, of course, that can give you the 60 marks.
You beg.
I'm also human, no. I've broken down. So today after this, my last one. Because if I break down,
break up.
no, I'm human. I also have my limits. And Monday, I'm also starting ICA class again, Charlie. I haven't rested. Just after their results, they finish writing now, maybe a CIT intervention. No more results about me, start ICA. No off day, Charlie. I'll break down. So I need to take it easy. So we have the comparable uncontrolled price method, right? So the comparable uncontrolled price is what we call the cap method. Now, cap method, what is the condition that is price? So cap, you use it when, are you getting it? There's enough information, like there's reliable information. So if there's reliable info and there are comparables, are you getting it? You can easily use what? The CAP method. And the CAP method can usually be used for intangibles, you remember, right? So if you have routine intangibles, you have intangibles that have similar licenses on the market, you have stocks, okay, like the stock exchange. If I want to price a stock, I can go to the market, the stock market, and look for a similar stock. I get to use it to price these goods. I get to use it to price this stock or shares. That's what we mean by stocks. Then financing. If I want to give a loan to somebody right now, I can just go to GCB, look at how they give their loans, and use it to give the loan. Do you get it? And general goods and services. So far as there's enough information, I can use CAP for anything. So CAP is the best transfer pricing method if only there's reliable information, right? And it is also the less reliable method when there's no enough information. So this is when to use CAP. So when you see intangible stocks, financing, general goods and services, you can use CAP. Meaning that any method you apply, so far as there's information, you can apply it together with the CAP method. That's one of the tricks. Don't just go and say the appropriate method is cost plus. No, you can say it's cost plus, but it can be examined together with the CAP method. We never ever apply only one transfer pricing method. It doesn't work like that. We apply one or two or three. I get it, but the most likely one is the one that will shine. So that's the CAP method. Makes sense. Now, the next thing I want to talk about resale price is the next method I want to talk about is resale price, or sometimes you can call it the resale minus method. Now, what is the trigger? Now, for the resale price, first of all, there should be what? A resale, right? So, first of all, it should be that somebody is buying to resell. So, it's like you buy something from a related party, then you resell, I get, or you resell to independent parties. So there should always be a resale to what? Independent parties. Little or no value. Okay. So little or no value should be added before the transfer. Okay. So little or no value should be added before the transfer. I get it. And it should be in a sale or distribution function. So these are the things you see in the case. I get it to tell that, okay, this one is a resale value. Okay, so here we depend on an appropriate arm's length margin. Okay, so here we look at the people in the market, the margin that they are applying. Are you getting it? Less the little or no value we have added. Are you getting it? Before we get our transfer price. So here your transfer price is equal to what? Taking the resale price, okay, minus the arm's length margin. That is the margin by the people on the market, less any little value that you added. Maybe you added some stickers to the thing before you transferred. We take all out, we come and get the transfer price. This is how this method works. Do you get it? Should we take a question?
Yes.
Yeah.
Good. So it's the triggers that you are seeing, the things I've written that you are going to use to determine what method should be applied. I'm coming. This thing's slowing down. Let me get some water. So look at this question, right? Brando Ghana is a Ghanaian distributor of the Helix brand television, and its sources its stock from parent company in the UK. The margin earned by similar television distributors in Ghana is 15%. The price per the Helix brand TV to customers is 3,000, and the cost per TV to Brando Ghana is 2,500. As a transfer pricing specialist engaged by Brando Ghana, you try to get further information from the group without success, right? So we didn't really have the price, but then we had what similar parties I get in having an average margin of what 15%. Is that not so? So the question is, what must be the most appropriate method? Looking at this. So you have to look at the circumstance, right? So all facts and circumstances. He buys the TV from his parent and resells to what? Third parties. No be so?
Yes.
Okay. So he buys from the parent at 2,500. Then he resells at what? At 3,000. Does he add anything to it before he resells? Does he add anything to it before he resells?
No.
No.
No. So that means no value
No.
was added, right?
So resale price.
Yes. So one, there was a resale to third parties. Two, little or no value was added, and there was a selling and distribution function. This makes the resale price the most appropriate what method. So how do we determine the selling price? We get the transfer price, right? That's how much you should have bought from the parent. Should be what? We said is your resale what? Price minus what? Minus the arm's length margin, right? What independent parties are charging, the margin that independent parties are charging, minus any little value you add. So here it's little or no value, but here there was no value at all. So what's the resale price? We sell to people at 3,000, right?
3,000.
But then independent parties charge 15%. So we'll take that 15%, assuming that was the profit we made on the 3,000. I get it. We take it out minus any little value. There was nothing. So 15% of the 3,000 should have been 450, right? So 3,000 minus what? The 450 would have given us what? 2,550, right?
2550.
Yes. So it means that we should have bought from our parent company at what? So we should have bought from Brando Group, right? We should have bought from Brando Group at what? 2,550. But we actually bought it at what? 2,500. No, be so? You get it? So we should have bought it at 2,550, but we bought it at 2,500. So what's the transfer pricing adjustment? The transfer pricing adjustment should be what? The 2,550 minus what? The 2,500, which means we'll pass what? 50 cedis per unit. Are you getting it? As an adjustment to our profits. So if I am supposed to prepare the profit statement or the P&L of Brando Ghana, the sale was how much? So did Brando Ghana understate to overstate profit?
Understate.
Understate profit, right? No,
Yeah.
they
No,
overstated profit.
Hey, overstate, sorry.
You know why? This was a cost. Their cost was lower. So they recorded cost of 2,500 instead of 2,550. So understating cost means you're overstating profit. So if they are overstating profit, what should we do? We should increase the cost. Is that not so? So if you are preparing the account again, we'll take their sales. What was the original sales? They sell to people at what? 3,000. So the sales now becomes what? 3,000. Okay. Then now we less the cost of sales, right?
Yes.
We less the cost of sales. So cost of sales, we had what? The purchase. So the original purchase price was what? 2,500, right? Then we add our transfer pricing what? Adjustment. So transfer pricing adjustment is 50. So that gives us 2,500 what? 50. There was little value. So that means that the net profit now that we are going to get will what? Will be 450. You get it? Which is the same as the arm's length margin that we would have gotten. If this thing wouldn't have been done, then we would have had 500, right? Which is the profit they had before. So the profit was overstated. But doing this adjustment now, adding this transfer pricing adjustment to the profit, we have now gotten the proper net profit which any independent party on the market would make on a similar transaction like this. So this is all about the resale method, though. Nothing else.
Prof, but shouldn't GRA be happy about overstated profits?
Not necessarily. Let me explain. You see, at the end of the day, they are looking for group synergies. So look, the guy in the UK, if your profit is overstated here, in the UK, it is also understated there. Do you understand?
Yes.
Aha. So it's the entire group benefit, affects our transfer pricing documentation. So it doesn't mean that if they've overstated profit here is good, you tax them more. But it is reducing profit, which the entire group can end up with a reduced profit and cost saving. And in the long run, it will cost Ghana. So that is the objective. So these people manipulate profit. It doesn't mean that tax minimization is always understatement. Darby, I can overstate profit with the benefit showing up in the next 5 years, and you will not even see it because it's the entire group benefiting.
Okay, thank you.
Makes sense. This
Yes.
question is very simple. Can we do a difficult one?
Yes. Yes. Yes.
Can we do a difficult one?
Yes.
Okay.
Yes, Prof.
But you understand this question. Everybody on the call understands.
Hello, Prof. Please,
Yes,
what would
please.
you do with the 50?
Which 15?
You see the overstated profit of 50. I got that it's supposed to be 450, but then with the 50, like where do you pass an adjustment for the 50? Or you just indicate that the 50 is overstated?
No, but what did I do with the 50? Who can tell her what I did with the 50?
You added it to
I
your
added it to the cost.
Added it to the cost as TP.
Okay.
So I added it to
so
the
that
cost as transfer pricing
it-
adjustment.
Okay. Okay. Thank you.
If you feel like you cannot do that, just take the existing profit of the 500 and just less the 50 from it as a transfer pricing adjustment. Then the new profit becomes the 450. Do you understand? So you are just adjusting your profit with it. It's overstatement less the
Okay.
original. If it's an understatement, increase the original profit. That's all.
Okay. Thank you.
Yeah, okay. But you understood how the method is applied.
Yes.
Good. Any
Thank
question?
you.
You're welcome. Any question? Any question?
Prof, could we please solve a question on the comparable uncontrolled pricing method?
I'm coming. You relax. Hey, yeah, Kekako. Anna.
Okay. Yeah.
So relax. I did for you. No fear. I'll solve every kind of method with proper calculations for you to understand how it works before I can close my close. Alright, okay. Even profit split, we'll do some. We'll do the comparable profit split and do the residual profit split. The questions are too many. I'm coming. I'm scrolling. I'm looking for one with. Okay. February 2022, question 5B. Now, Tobol Incorporated is a multinational company resident in Belgium, manufacturing television sets and introduced a new model, the high-tech VT. The technology used to develop the high-tech VT has features that reduce radiation from the TV screen by 80%. There are other new manufacturers springing up in Africa that have also developed similar technology for other television sets to suit the African market. Tobo Incorporated owns several subsidiaries across the globe, including Camel Limited, resident in Ghana. Camel Limited distributes the high-tech VT in Ghana and has 57% market share. So you see how it happens. Tobo manufactures, then who distributes? Tobo manufactures, then who distributes?
Camel
Camel.
Limited.
Camel.
Camel distribute, right? So you are looking at those features. There are other distributors or similar TV sets who also buy from other manufacturers in Europe and Africa. So since there are other distributors like this, it means that we can easily get what an arm's length margin from the other distributors. Meboa. The
Yeah.
only value added to the TV sets by the distributors is English translation manual. Is that big value or little value?
Little value.
Little value. So do we see the features? One, was there a resale happening? Yes, there's a resale happening. Two, was there a selling and distribution or marketing function? Yes, there was a selling or marketing function going on. Two, there were other similar distributors in the market. True or false?
Yeah. True.
Three, little value was added. True or false?
True.
Meaning, what method can be applied here? The resale price.
Yes.
Do you get it? So it's always the features or the things happening in the scenario, the conditions that will tell you what
Method to.
The kind of
method
method
should
you
be
should
applied.
use.
Yes. You see, tiredness, I'm a bro for Nako. All right. So in that case, what do we need? So one thing you should understand is that these methods work at the gross profit level. The last time I was telling you that the transitional methods, they work at the gross profit level. So anything below gross profit, we don't consider it. We only work at the gross profit level. So turnover, direct cost, gross profit, yes, that's where we work. If you are doing the profit methods, that's where we look at the profits. So we go down to the net profit level. Do you understand?
Yes.
You get the idea? Yes.
Yes.
So now, because we are doing resale price, we need what? A margin. The company itself, what margin did it apply? Let's check the company's margin. Who was doing the resale? It was Camel. Mewa. Was it not Camel? So what was Camel's margin? We said margin is taking your profit over what? Your selling price, right? Or your sales times 100. So what was the margin Camel was applying in this case? So Camel was getting 174 out of what? 57 what? 21. So how much was Camel charging? Remember, it's profit over sales. That's margin. Markup is profit over cost. We are looking for margin because this one is resale. Resale uses a margin. So Camel did what? 174 over 5721. And that's what? 3%, right? So Camel has 3.04%, right? Profit on this transaction. Okay, good. Now, independent parties on the market, we have to go and check. I get the independent parties on the market whether they made the same 3.04 or they did higher or lower. Then it would mean Camel has deviated, right? So we can only depend on what independent parties do. That's transfer pricing for you. So in that case, let's see where Camel exists. So if we know where Camel exists, we can easily get what? Other people who do that. So Camel is resident what? In Ghana. So we need other third parties or other independent distributors who are also resident where? In Ghana. So look at what your examiner did.
Can we have the question again?
Hey.
So look at it. In Ghana, in Netherlands, in Africa, in Europe, who are we dealing with? Are we looking at gross markup for manufacturers or we are looking at gross margin for distributors? Which one are we looking at?
Gross margin for distributors.
Gross margin for distributors. And which one are we looking at? Is it in Netherlands, Ghana, Africa, or Europe?
Ghana.
In Ghana.
Ghana, yes, because Camel exists in Ghana. So we are going to use the average of 20% that independent parties use and apply it on our sales. Do you understand?
Yes.
Yes.
Good. So if you look at it carefully, what was the profit that this guy made?
174.
Let's go back to the question. He made profit of 174, Meboa.
Yes.
He made profit of 174 from the transaction. But if we are actually applying the arm's length, how much profit should be made? So if we want his arm's length profit, in this case, what would it be? His arm's length profit in this case should be what? That 20% on the revenue. No be so?
Yes.
True or false? So 20% on the revenue would be what?
1144.
1144.
1144.2.
1144.2. Okay, this is the profit that this guy should have made, but he charged what? 174. If I take it out, this becomes a transfer pricing adjustment that should be charged to this guy's profit, which is how much? Minus 174.
970.2.
Yes, that means this 970.2 should be the transfer pricing adjustment. So if I pass this 970.2, I getting it back to the revenue. That means that it should have been this, right? Which means if I subtract this cost from it, I'll come and end up with a 1144.2 as his actual profit. So this guy understated profit, didn't he? Didn't he understate profit?
Yes.
Yes. He
But this is
understated
a
profit.
primary adjustment.
Yes, so this is a primary adjustment. Is this thing difficult? That's
No.
it. And one year. Okay. Resale price going is gone. Can we go to cost plus?
Well, can you show the question again, please? I just want to take a
Question
snapshot
is
of
right
it.
in front of you. And you keep saying, can I show the question again?
No,
Question on the
the
whole.
beginning,
So say the preamble.
beginning part.
So this is the preamble. February 2022, question 5B. The empty barrels make the most noise. You see how the question is long. There's nothing inside. So this is the question. And this same question, they brought it again as profit split. So students who saw this one
Yeah, in
thought it was
August.
profit split. They
August
thought it was
2020.
profit. They thought it was profit split, and then they made mistake, but it wasn't profit split because the conditions doesn't have any unique intangible asset. Remember what we learned. If there's no unique intangible asset, you cannot use profit split. They are testing the conditions. Transfer pricing, don't rush into calculation. First check. You see, we tested all the conditions. There are other similar distributors. Little value was added. The selling and distribution function. There's a resale of whatever was bought from the parent, and there's an arm's length margin in the market. So far as you can confirm this, you can apply the resale price method. All right. Okay, resale price. Are we okay now? Can we move to cost plus? Can we move to cost plus?
Yes, Prof.
Okay, so how does cost plus work? So let's go back to our table. Cost plus method. So with cost plus method, it says cost plus. It means you are taking some cost plus some arm's length profit to get the selling price, right? So you see, resale price worked like this. Resale price worked as what? Selling price minus what? The profit should give us back the cost we should have bought. The arm's length profit. Do you get it? But here, cost plus uses an arm's length what? An arm's length markup because it's a percentage of cost. That's the difference. So whatever you use resale price and cost plus for, you can use transactional net margin also for the same thing. Just that with the transactional net margin method, what you are going to do is that you are going to what? Work at the net profit level, not gross profit level. So you are going to use a net markup if it's involved in manufacturing or services, and you are going to use a net margin if it is doing resale. Okay, so from this, once we understand this method and we talk about cap, I get it. You see, even the question we looked at now, if there's adequate information, you can tell the examiner that you can use the resale price method together or along with what? The cap method. If there's enough information. Always that's cost you extra marks. Is it clear? Is it clear?
Yes, sir.
Yes, sir.
Okay, so this one, what is the rule? The whole thing is that here, if you want to use cost plus, then you are looking at somebody into service business. Okay, so if you see somebody is into services, that's why when we looked at intra-group services, I said the cost plus method is the most appropriate method. Do you remember? when we look at the intra-group services, do you remember I said we can use the cost plus?
Yeah.
Do you remember? And also the low value added intra-group services, we said 3% markup. Do you remember?
Yeah.
And then the OECD, I said 5%. So if you see low value added intra-group services, the transfer price will be like taking that cost the person made and adding a 3 to 5% markup. Are you getting it? To come and get what the selling price should be, which is the transfer price. Okay, so service business use cost plus 2. When you are into joint manufacturing or manufacturing, right? Anytime you see these issues in a case, it tells you straightforward that these people should use what? Cost plus. So with a cost plus, all you do is take the direct and indirect cost that the related party has done and add what? An arm's length markup, right? An average markup that independent parties on the market use, then you come and get the transfer price. So it's taking the cost, the total cost, adding an appropriate market markup and getting what your selling price or your transfer price. So cost plus profit equals selling price. The same profit rule. That's how you do cost plus. Are you getting the idea? So cost plus is relatively very easy, but still you must conduct the normal functional analysis to see whether the independent party who you are going to apply the arm's length markup for is just in line with what you are looking for. So let's see if I can get a question for cost plus, and then yeah, good. I think I've gotten a question. All right, so let's see. But so far you are getting the methods, right?
Yes,
Are you
sir.
getting how they work?
Yeah.
Good.
Yeah.
So let's look at a question with cost plus. Oh,
It's left with the
Peter Nikawa,
calculation.
great. You said?
It's left with the calculations.
Which calculation again? And your calculation no na yeah no. Hey,
Hey.
yeah, calculation. That is left with the calculation. Calculation baby of the officer.
Differentiation of the calculus.
Calculation now, which calculation again are you looking for? Maybe explain the calculation you are talking about because I don't understand the calculation you said is left with. Which one?
The resale one.
But resale, have we not done all the calculations for resale? Or you are not on the call then?
I was on the call.
But you said the resale one, we should do calculation. Have we not done that calculation for resale? 2 different calculations. We did one for the brand Ghana.
Yeah, that one
And
was
we came to
easier.
do one for, and that's how far they can go. There's
Don't go and
nothing
learn
they
it.
can do with price again.
Oh, okay.
Do you think there's something else that can be done? No, that's how far they can go. Even at the advanced levels, at ADIT level, we don't even go that far.
Oh, okay.
Prof, should I
So
read
it
this?
ends there. Yes,
Thank
please,
you.
you can. You're welcome.
Okay, please can you scroll down so that sorry, scroll up. Okay, Company B, resident in Ghana, specializes in the production of chipboard for related overseas person under a contract manufacturing agreement. Under the arrangement, Company B would be provided by the overseas related persons with all the technical know-how used in the manufacturing of the chipboards and manufacturer to the order of the related parties. Company X is an independent contract manufacturer of chipboards in Ghana. It sells the product to an independent German distributor. Similarly to Company B, it is provided with technical know-how by and it manufactures to the order of the German distributor. Company X is identified as an external comparable person, charges an average markup of 10%. Company B's profit statement is shown below. We have sales to associate as 400,000, then direct costs and and indirect costs, both
So
giving
we can see all the
260,000.
numbers, right?
Yeah.
Yes, we can see all the numbers. So what's the requirement? Let's go down. Come in.
Okay. So
It's loading. The PC is tired. Coming. Since yesterday, I didn't put it off.
Okay. Requirements. What is the most appropriate transfer pricing to adopt for manufacture and sale of chipboards to the associate? B. Calculate an appropriate arm's length price for with the method described in A. Then C. Determine any transfer pricing adjustment and prepare a revised profit statement. Thank you.
So, thank you. You're welcome. Now, what is the most appropriate transfer price to adopt for manufacture and sale of chipboard? Manufacturing, what method should come into mind?
Cost plus.
Cost
Cost
plus.
plus.
Cost plus. If you
Cost
see
plus.
services, what method should come into mind?
Cost
Cost
plus.
plus. If you are even
Cost
doing
plus.
manufacturing and there's more available information, you can do cost plus together with the cap method. Mebwa.
Yes.
Cap.
You understand? This is how the methods work. Or it looks too easy. That's why you are not convinced.
Yes. It's because we understand now, Prof.
Yes, it's because you understand now. That's why you are not convinced. Because I said, no, I did the F. Yes, I did here. What I say, F. That's the thing. All right. So now we are saying that anytime you see manufacturing or you see services, the first thing that should come to mind is what? Is cost plus. And I told you cost plus, what's the rule? Cost plus profit equals what? Equals selling price. And the cost, we are looking at the direct and what? Indirect cost. No, be so. Then you add an appropriate margin, markup to it. So first of all, let's go and check whether we have independent parties who are doing this manufacturing so that we can use their average markup. Does it make sense?
Yes.
Good. So now let's look at it properly. Company B is resident in Ghana. He specializes in producing chipboards. The word producing chipboards alone tells us that there's manufacturing. Meboa. For a related overseas person. So he's doing it for an associate. Under contract manufacturing arrangement, cost plus, Meboa. Under the arrangement, Company B will be provided by the overseas related party with all the technical know-how used in the manufacturing of the chipboards and manufacturer to the order of the related parties. Company X is an independent contracting manufacturer of chipboards also in Ghana. Do you get it? Where? In Ghana. Company B is also in Ghana. Can you see that? So, can we use this independent parties margin for our transaction?
Yes.
Is there an arm's length margin? Yes, it is. And
Yes.
this guy sells to another independent party who is a German distributor. Similar to Company B, it is provided with technical know-how by and it manufactures to the order of a German distributor. Company X is identified as an external comparable, charges an average markup of what?
10%.
Of 10%. So Company B would have made a different markup, right? Which may be above or below the 10%. We are not concerned. We want to use what independent parties are using on Company B's what? Total cost. So what becomes Company B's total cost? Let's determine the transfer price. His direct and indirect cost, when we add all, it adds up to what?
260.
260,000, right? So that means the appropriate transfer price, the appropriate method, we have already said it. And why is the appropriate method, right? I told you always which method and why the which. That's the style. So which and why the which? Which method? Cost plus. Why the which? Because they are involved in manufacturing. Are you getting it? Okay. So the transfer price becomes what? The cost, the total cost plus what? An arm's length what? An arm's length what?
Markup.
Markup. Do you get it? So in that case, we are saying that the total direct and indirect cost was what? 260,000 also.
Yes.
Then we add what? What was the arm's length markup that the independent party was charging?
10%.
10%. So we do 10% on the 260,000, and that gives us what? 26,000.
26,000.
So that means our transfer pricing, our transfer price becomes 260 plus 26, which is 286,000. Okay, so this is how much you should have sold to your associate, but you sold it at 400. So what have you done? You have overstated profit by how much? So what's our transfer pricing adjustment? So that means that the sale price was what? 400,000, right? But we should have sold it at how much?
286.
The transfer price of 286. That means how much should be passed back to the profit?
114.
114,000, right? Okay.
Yes.
So if I subtract 114,000 from the existing profit of 140, what do I get? Is it not the 26,000 still that I get?
Yes. Yes.
Yeah. So at the end of the day, you should come and get back after the adjustment. You should come and get back the arm's length profit that you did. Does it make sense?
Mm.
So this is all about it. And this funny, the funny thing is, this question was 50 marks.
Mm.
What are you going to write again?
That's all you do, and you get the mark. It looks too good to be true, eh? It's because now you understand.
So the C that says that determine any transfer pricing adjustment. So we can just do the net profit minus the
You see where it
140.
says revise profit statement. So because it says revise, you have to rewrite this statement again,
Oh,
right?
okay.
But because they overstated profit, you are now going to maybe increase the cost. So here I can say transfer pricing what adjustment. I'll rewrite everything, but I'll say transfer pricing adjustment. Then I'll put the 114 here. Do you get it? So that the net
Okay.
effect will still remain 26,000
Okay.
here.
Okay. So what
So
if
you adjust the account.
okay, sir. So what if I rather do it maybe the sales less transfer pricing as before I bring the direct cost in there. Oh,
Yeah, of course, they'll still mark it for you. But I prefer to always add, not deduct. I don't like deduction. So I always
oh,
add. So if
oh,
it's understatement, I'll rather add to sale. If it's overstatement, I'll rather add to cost.
okay.
But if you either take it from the sale or add to the sale, it's not bad. It's still at that. It's still accepted. Yeah, you want to
Yes,
ask a
Prof.
question?
I was thinking, let's
Mhm.
say this particular question is
Yeah.
almost fine. Then you realize that okay, you are not too sure of the adjustment.
Then you can take the
So can you
profit
copy
and
back?
then check.
Let me land. So let's say, can you just, they say you should prepare a revised profit statement. So can you just copy back what is here without necessarily the adjustments in case you are really out of time? Maybe you can get 6 for that.
No. Without the adjustment, you don't get anything. That's the funny
You
thing.
wouldn't get 6?
No, this one there's no ticks for it. It's the adjustment they actually want to see in the revised profit statement.
Okay.
Do you understand?
Yeah.
So you and a student who just take the profit and less 114, that guy will get marks. You'll not get anything. The main aim of transfer pricing is a transfer pricing adjustment. Yeah. Do you get it? Please soak this thing small, eh? Just ponder over it, whether it makes sense.
Hello. Hello, Prof. Can I ask a question? Please, the difference. Why is it not deducted from the sales by reducing the price of the rather adding it to the cost?
Please, what were you saying? Sorry.
Hello.
Yeah.
Miss, I was asking why the difference was added to the cost instead of reducing the price if the price is overstated.
That's why I'm saying all are, you are adjusting the financial statement. So all are accepted.
Okay. But if you are adding it to the cost, what description will you give it to it?
No, I said it's called TP adjustment. So you just say TP adjustment. I even indicated it there. Plus TP adjustment or minus TP adjustment.
Okay, sir. Thank you.
All right. Are we okay with the
Hello,
cost
Prof,
plus?
please, the the did it mean to say transfer price method was the same as A? So I wanted to ask whether that one is the transfer price method.
Yes, they're asking what's the most appropriate transfer pricing method. Maybe it's a typo. When I was typing, I forgot the.
Okay. Okay. All right. Thank you.
Okay, so we have seen the resale, we have seen cost plus. We are literally done with the, what do we call it? The traditional methods, right? Okay. Now, I want to teach you about the transactional net margin method, okay? Then after the transactional net margin method, we'll come and do resale price, then we close. I hope that sounds fair. I hope that sounds fair.
Yes, please.
It's already 10 o'clock.
So did you say resale or profit split?
Profit split. Hey, bro, no fan chairman. Okay, I'm coming. Where's transactional net margin? I'm looking for transactional net margin. Oh.
You just skipped it too. It was it appeared, but you just moved to them.
Oh, yeah. Okay. So this is a question that has popped up several times, right? Where they ask you to identify and explain the performance level indicators or the financial indicators that can be used as part of the transactional net margin method. Now, the transactional net margin method, okay, allocates prices or profits based on what? Net profit comparative to an appropriate base. So it uses markups and margins. Are you getting it? That's net profit to something. You see the resale price and then the cost plus. The transactional net margin works that way, but now it doesn't work at the gross profit level. It works at the net profit level. And here, some value should have been added to the product. So it means that here, yes, the person can do manufacturing, right? But he would have added substantial value to the product. Do you understand? The same way, the person can do a resale. So it means that I can buy from my parent company and then I'll resell to third parties. Do you understand? Just like how the resale price works. But now I add some big value to the thing before I sell. Do you understand? By resale, what's the difference between this one and resale? Resale, we don't add big value. We only add small value or no value. Do you get it? So this is what will tell you whether you are using transactional net margin or you are using resale. Resale, no value at all. Little value will be given. But what? Transactional net margin, big value will be given. Do you understand? So with this one, transactional net margin, you are using net profit relative to an appropriate base. You can use net profit over sales, meaning you can use a net what? A net margin. Do you understand? You can use what? A net margin. So net margin is only used, that's net profit to sales, if you want to determine the arm's length price of purchases from associated enterprises to resale to independent customers. Can you see that? So the sales revenue that is derived from uncontrolled transactions should not be included in what? In the calculation. All right, so that is net profit. We can do net profit weighted to sales. The same way we can do net profit weighted to cost. When do you think we'll use net profit weighted to cost? When we are dealing with services and what? Manufacturing. Do you get it? It looks just like cost plus. So the way the resale price was gross profit to sales. This one becomes net profit to sales. The way the cost plus works, here we can use a net markup, which becomes net profit weighted to cost. But this is used when cost is a relevant indicator of the functions performed. Are you getting it? Like when you are dealing with manufacturing or contracting, contract manufacturing or asset intensive activities, okay, that require a lot of costs. And the cost we are using the operating cost. Do you understand? When it comes to net profit to assets or net profit to capital employed, this is mostly for certain manufacturing or real estate companies. Okay, then we have something we call a Berry ratio. Berry ratio is where we do gross profit to the operating expense. This is the only time we do gross profit to operating expenses, right? Or gross profit to cost. Now, the Berry ratio is only used where an associated enterprise A sells to another associated enterprise B, who then resells to another associated enterprise C. So Berry ratio, the resale is not to independent parties, it's also to another associated person. Do you understand? So this is when you are doing intermediary activity. So company A buys from its parent and resells to another subsidiary, not third parties. Then we use what do we use to determine the financial indicator? The Berry
ratio.
which is gross profit to
Berry
operating
ratio.
expense. You understand? Then we have other net profit ratios. So this one is where you can weight net profit to anything, net profit to working capital, net profit to labor costs, net profit to inventory. It could be net profit to anything depending on the particular scenario, right? But the common ones are net profit to sales, net profit to cost, net profit to asset, and Berry ratios. Are we okay? And can you imagine this small thing is 15 marks? Yes. 5 marks each for each indicator identified and explained up to 3. So 5 mark, 5 mark, 5 mark. 15. They only asked for 3. International tax is not difficult too. It's the easiest of all your 3 courses. If you don't get the right guide, that's when it looks so complex. It's so simple. And the marks are always huge. So answering it well alone means that your chances of passing are very high. And this thing, free Ubuntu, 50 marks. You are gone. The transfer price they do. But that's the part that students also don't like. Are they lie? Are they lie? Is it not the part students don't like? Okay. But I hope now transfer pricing is fun.
Yes.
All right. So now we have seen the theory, but now let's do calculation for the transactional net margin method. Transactional net margin, how do we apply it? Now let's do a question to apply the transactional net margin, right? Okay. So then you will see the difference between the resale price. So XYZ buys computer from SB Singapore at 1,500 per software. Okay, computer software. So you see that XYZ buys computer software from SB Singapore at 1,500 per software. Can you see it? Now, subsequently, the company, which is XYZ, incurs an additional advertising cost of what? 600 per pack. Are you getting it? In Ghana. And then he ultimately resells it at 3,000 per software. Do you get the idea? So as this transaction, is it a controlled or uncontrolled transaction? Is it controlled or uncontrolled transaction?
Uncontrolled.
Uncontrolled. Thank you. Because it's not with a group member. Do you get it? It's between you and an independent party. Good. And then look at what, after you bought it, you resold it by adding substantial value. Can you see that the value is huge? But if this was resale price, 600 out of 3,000, that's huge value. Mebwa. compared to resale price where it would have added nothing or maybe some 10 cedis. Do you get the difference? This is what will tell you that it's transactional net margin. Now, we didn't have any independent parties out there, but look at what happened. We also buy the same software package from our subsidiary, okay, at 700 per software, and we sell it at 1,002 to our what? To independent parties. But we also add advertisement cost of 200. I forgot it. There was an advert cost of 200 B. So there's an advertisement cost of 200 that will also be added. I get it. So you see, substantial value is added. So what happens is that you can see that we don't have any comparable, do we? Do we have any people on the market which we can use as our markup or margin? No. But the only comparable we have is that we sold to a third party, right? So we can use the markup or the margin from our transaction with that independent party and use it to what? Work our what? Related party transaction. Do you get it? So here we don't have people on the market. There are no definite comparables, but we can use internal comparables like what we have here. Does it make sense to work our transaction? So now let's use our comparable here and use it to now get what? The appropriate transfer price, because we bought it from our parent company at 700. Maybe the 700 is not the right price to have bought from our parent. Do you understand? Does it make sense?
Yes, sir.
Okay, so in that case, let's see what we have to do then. So first of all, let's get the arm's length markup we are supposed to use. So we have to determine the arm's length markup. So let's see if we can determine the arm's length markup. So what's our arm's length net markup? A margin, sorry. This one was a resale. So it's a margin. No, so was it manufacturing or it was services or it was a resale?
Resale.
It was a resale, right? Yes, and majority of the value. So why, the first thing is why, which method? Which method are we choosing in this case?
Transactional
Which
net
method?
margin.
Transactional net margin method. Why? Why the which? Why the method? Because
Wasn't any comparable.
one,
Net markup.
there weren't what? External what? Comparables. And substantial value was added, right? Substantial value, which was the advert cost, were added. And also, are you getting it? There was a resale to what? There was a resale to what? Third parties or independent parties, right? Or a selling and distribution what? Function. No be so? So the appropriate method is a transactional net margin method with a what? A net profit to sales margin. Or is it not net profit to sales that will be used?
Yes.
Yes. So you use net profit to sale when it's a resale to third parties. You use net profit to cost when it's manufacturing or services. Do you get a clue now? So we use net profit over sales. Yes. So that's what we'll be using. So let's get the arm's length margin. So with our arm's length margin, what we are going to do is that we are going to first say that, okay, we want our internal transaction we did, right? Which was XYZ buying from who? Buying from SB Singapore, right? The related, the independent party. So during that transaction, how much did I buy from SB Singapore?
1,500.
1,500. But I sold it at how much?
3,000.
Sales. We sold it at 3,000, right? But we bought it at how much? So what was our cost? Purchase cost. We bought it at how much?
1,005.
We bought it at 1,500. And then we incurred what? Value, right? Additional value.
600.
So we added additional value, which was the advert of 600. It means that the total should have been 2,000 what? 100. No be so?
Yeah.
So in that case, the profit, the net profit that would have been made on this transaction would have been how much?
900.
900. Okay. So what's the arm's length margin that we can use? You know this is an arm's length transaction, right? You don't know the person. So what's the arm's length margin that we have to use in this case? You see that resale price, the arm's length, we got it from the market because there were external people. Here we don't have external people. So what we can do is that we can rely on the internal comparables, or we can get external people who do something similar and use it. So in that case, we can say that, okay, net margin, our arm's length margin becomes what? Our profit over what? Our sales. This margin, right? Profit over sales times what? Times 100. And that means this will be 900 out of what? The 3,000. And that means what's the arm's length margin? What's the arm's length margin?
30.
30%.
30%. That means people on the market should be able to make 30% on similar transactions. So now we are going to use this to price ours. So we bought it from our parent company at 700, right? And sold it at 1,002. So how much should we have bought it from our parent company? So our transfer price should be what? I told you it's always the resale price. Are you getting it? Minus what? Minus the arm's length what? Margin. Do you remember? Do you remember? Minus any value. So yeah, I said there was some 200 value they added. I didn't bring it. So I sell it at what? 1,002. No, so. But then we make margin of 30%. So 30% of that 1,002, then less the value of 200 from it. Okay, so you are working back to get how much you should have bought from your parent company. So we should have bought it at how much? We should have bought it at how much? 2,002 minus
640.
200 minus 200. So we should have bought it from 640, right? But we bought it from our parent at how much?
700.
700.
So purchase was at what? Was at 700. So it means that there's a what? A transfer pricing adjustment of how much should be passed? 60. So 60 should be passed. So if they tell us to readjust the financial statement, we can re-prepare. So was profit overstated or it was understated?
Profit understated.
It was understated because we acquired it at a more higher cost. No, be so.
Yeah.
So in that case, what are we going to do? When we are preparing our revised financial statement, what we can do is that we take the same financial statement. Our sale was what? 1,002, right? So since profit was understated, we can do a transfer pricing what? Adjustment and add what? The 60 to our profit. Do you get it? Then we less what? We less our cost, which was what? The purchase cost of how much? 700. Then we have what? Our advert cost, right? The value of 200. So this one, if we add, we have 900. Then this one, we have 1,260. So 1,260 minus 900, what becomes the net profit in this case?
360.
You said?
360.
360. So this becomes the same as the arm's length margin. Try and see the arm's length margin. When we took the 1,002 and multiply by 20%, what do we get? 30%.
360.
See, it's the same. C is the same.
Prof, the additional cost of 200, was it in the question?
I told you I forgot it. It is there, but I forgot it. I said when I was typing, I forgot it. These are my own questions.
Okay.
So I forgot it. These are we talking?
Yes.
All right. So let's go to the profit split method. Then we close. Now, when it comes to profit split, okay, let's first understand. So what you are doing, there are no comparables, right? So let's say that we decided to do a manufacturing project or development CCA, okay? We are building a dam for somebody. And then we have entity A, entity B, entity C, okay? Now, entity A contributed what? 50% of its resources. Entity B contributed what? 30%. And entity C contributed what? 20%. Do you get the idea? Now, with the profit split, what we are saying is that this is a contribution of each person. Do you understand? Are you following? So, assuming a profit of 100 million comes, you get the idea. We are going to split according to these percentages. That's how profit split works. Does that make sense? And this is our routine functions that we are doing. Now, assuming this guy was doing procurement and production, this guy was doing finance, this guy was doing maybe IT, okay, in this thing that we are doing together, okay, and then we don't have the similar dam that we are building, but other independent parties building a bridge, okay, arm's length wise, they contribute what? Somebody who looks like A or performs the same functions as A, okay, on the market will charge 30%. Somebody who does the same thing as B will charge what? Will get maybe 25%, okay? And somebody who does the IT that C is doing will charge, let's say this guy will charge rather 60%, and this guy doing 25, the other guy will also do what? 15%. Do you get it? So it means that when you look at what independent parties are doing, it's different from what we would have done, right? So look, if now we are sharing the profit on their profit statement, what would they have? A would have made how much of the sharing? A would have had what? Is it not 50% of the 100 million? A would have gotten 50 million. No, be so. B would have gotten what?
Yes, sir. 30%.
Which is
30.
30 million. And then C would have gotten what?
20%.
20% of the 100 million, which would be what?
20 million.
20 million. Okay. Now, if you are looking at it from arm's length, okay, which is what independent parties would do, the independent parties in the same similar circumstance would have charged how much? The one who looks like A would have charged how much?
60.
Yes, he would have charged what? 60 million. No, be so. The one who looks like this guy would have charged 25 million, and the one who
25.
looks like this guy would have charged what? 15
50.
million. So, by comparing to their profit, have they been understatement or overstatement?
Some under and over.
Yes. So let's see the transfer pricing adjustment that should be passed to their account. A should have charged profit of 60, but he charged 50. It means that he has what? Overstated profit by 10 million. No, be so. So we take 10 million out of his profit. No, be so.
So you did.
Understated.
No, you said
He has
he
understated profit.
understated instead. Yes.
So we added
add.
10 million to his profit. Okay. Then we come to this guy. He charged 30 million instead of 25. So he has overstated profit, right? So we take how much? 5 million from his profit. No, be so. Then we come to this guy. He should have charged 20, but he charged 15. We also take 5 million out of his profit as an adjustment. No, be so. Overall, the total adjustment should always add up to 0. So this is what we call comparable profit split, or what we call contribution analysis, where we only share routine profit. And if there are other people doing similar things on the market, we can use an appropriate method to share their profit based on a markup or a margin. Are you getting it? And then we find a transfer pricing adjustment. Here, nobody contributed to any unique intangible asset. We are just splitting according to the percentages that the commissioner deems right. If your percentages are different, creating a particular profit will compare to what independent parties would have done. Then we pass a transfer pricing adjustment, just like I have done there. It's very easy. That's why your examiner never even asks about contribution analysis. He is only concerned about residual profit. Are you getting it? Analysis. Good. So let's look at residual profit split. Now, residual profit split is where people have contributed to a unique asset or a unique intangible asset, right? So this one, there are some steps. One, the first thing you have to do is first what? Determine the total profit, right? So you are going to determine the total what? Profit. and the total profit will be adding their total profit on their financial statement, A plus B profit, right? So get that profit. So once you get the profit, now you are going to determine their routine contribution, right? So you are going to determine their routine profit, okay? And the routine profits, I prefer you use the transactional net margin to determine the profit, right? I prefer you use what?
Transactional net making
Transactional net.
To determine that routine profit. And using transactional net margin to determine the routine profit means you're either finding a net markup, right? So if it's a markup, if it is manufacturing or services, then you need a net markup, right? And a markup is a percentage of what?
cost.
It's a percentage of cost. So if you want to get the profit, you are going to find the net markup and now multiply by the total cost, right, of the guy who is using the markup. If it has to do with what, something like manufacturing, do you get it, or service? If it is what, a net margin, then the routine profit will be what, taking that net margin and now multiplying by what, the
Sales.
sales. Do you get it? And this one will be when the person is involved in sales or distribution. Do you understand? So this is the rule. So after you're able to determine the routine profit, then you need to now get the residual profit. Okay, so the residual profit is simply your total profit minus the routine profit that you allocated from the top. Do you understand? Do you get it? So when do we use this? We use this when, one, there are no comparables. That thing we are using is not common. There's no comparable, right? And at least one party contributes towards what? Unique intangible asset, right? So contribution towards what? Unique intangible assets. Okay? So these are the things that you are looking for. So your residual profit is equal to your total profit minus your routine profit. And then finally, you allocate what? Allocate the residual profit according to their unique intangibles, right? According to the unique intangible assets, right? The unique intangibles. How do you do it? So let's say that if the unique intangible was R&D, okay, and then entity A contributed 50 to R&D, entity B contributed 100 to R&D, that is 150, right? So this one becomes 50 out of the 150 times what? The R&D. Do you get the idea? I said the R&D, the routine profits, and the residual profit, right? So we split the residual profit here. Do you get it? Then this one becomes 100 out of 150 times what? The residual what? Profit. Do you get the idea? So that's how we share the residual profit. Then when we finish, we now come and get what? The arm's length profit. So the person's arm's length what? Profit for each of them now becomes what? The routine profit plus the what? The residual profit for each of them. Do you get the idea? So once you're able to do this, that gives you the total profit. Then to get your transfer pricing adjustment, what you are going to do is you are going to what? Compare the actual profit to the arm's length profit. Okay. And the difference gives you the transfer pricing adjustment. So this is how you do residual profit split. So can we take a question that we close?
Yes.
So, do you get the steps? Yeah, so these are the steps. So first, get the total profits that they have, determine the routine profit, and you can use TNMM to determine the routine profit. Get a residual profit by taking the routine profit out of the total profit. Allocate the residual profit. Are you getting it? Then get the arm's length profit and compare to the actual profit to get your arm's length profit. So let's look at a particular question. This question, I think this question has appeared several times. So maybe I'll do two questions with you and you see how easy this thing is. So I'll do this one and do another one that looks like this, and then you are fine. I mean, okay, so yes. Okay, so Vertex Corporation. You can see. So Vertex Corporation is a Chinese resident company. It's a manufacturer. You see, manufacturer of electronic products. So immediately you see manufacturer. Is it net markup or net margin?
Net markup.
Net markup. Thank you. It means now you are getting it. One of its latest products is the ultra wide screen LED TV set. So this guy manufactures what? TV sets. Is that so? The major component, which is the ultra flat 3D screen, is developed and made by one of its subsidiaries. Can you see that? Hemlines Company Limited, which is a Ghanaian resident company. So this guy makes what? The TV screen. Then it will now give the TV screen to what? This guy, who now what? Manufacture the TV set and resell to third parties. No be so. So Vertex Corporation sells all the manufactured TV sets to an independent distributor. Can you see what is happening there? Selling to an independent distributor. Is there a markup or a margin?
Margin.
Selling to an independent distributor. Is it
Margin.
markup or a margin? Margin. So it means Hemlines, I get it, makes the screen, sells to what? Vertex. And Vertex now redistributes to third parties. Because this guy is only manufacturing, it's a markup. Mebwa. Because this guy is manufacturing and reselling, it's a margin. Do you get it? But since this guy, does he add little or no value to it, or he has substantial value before reselling it?
Substantial value.
Substantial.
He has very big value, right? He just got a screen from this guy and added a whole TV set. So the value is so big. Do you get it? So it tells you we can never use resale here, because as you just took the screen and resold it to another person without adding anything, then that would have been resale price. But here he added a TV set, a whole TV set to the screen and sold to third parties, meaning that very big value was added. Do you understand? So you see all the methods really look the same, but it's all about the value, the economic value, which is inside. Makes sense? Good.
Yes.
You see how easy the methods are? So let's see. There was no comparable for the product. Immediately you hear there was no comparable. What method should come to your head? Profit split. Mebwa. No comparable, profit split. Okay, the flat white 3D TV set appears to be a unique product. Another thing, another clue we've seen. Unique product. Unique product means there's a unique intangible. Go and check the financial statement if there was something like R&D or intangible asset. There was, right? Good. And here you see it's empty, but it's not empty. If you add all, if you take the sales and less all the expenses, you don't get 42. It means something is missing. That's the R&D for this guy. So when you balance it off, it is 11. That is there. However, they said no company has the technology to manufacture such television, meaning it's very unique, right? However, you have been able to locate a number of manufacturers of TV screens, as well as what? A number of manufacturers of TV sets. However, the products they made are not as advanced as what? As advanced as the ultra-wide TV 3D set made by Vertex Corporation and Hemlines Company. The following information was extracted from the published financial statement of the TV screen and TV set manufacturers. So who was TV screen manufacturers? It was what? Vertex. And Vertex manufactures TVs, resells, right? You know this guy manufactures TVs, Hemline. Hemline manufactures the TV screen, right? Yes, he only manufactures. But for Vertex, who manufactures the TV set, he resells to what? Third parties. No be so.
Yes.
So if you look at them, you see now there are several parties. So I told you anytime there are several parties, what do you go with? Do you go with average or you pick just one?
You go with average.
Average.
You
Go with average.
First question is, what is the most appropriate transfer pricing method to apply in this circumstance? 10 marks. Calculate the transfer pricing adjustment to be made, if any, by using the transfer pricing method you identified in A. 20 marks. Prepare the adjusted profit and loss of Hemline and Vertex, if any, that you made in B. 5 marks. 35 marks. That time, international tax, you can go and then only one question is 35. Then the other question is 10 marks. Then the other question is 15. But now they've made it 2020, 2020. So now this same question can be given to you as 20 marks. They don't care. Oh yeah, no, I went to me and now call him. So what's the first step? Let's follow our steps. The first step, we said what? We determine the total profit. Do you remember? Don't know what I taught you?
Yes, sir.
So what's the total profit? So hemlines made profit of how much? Let's go and see. So you can see their profit from their financial statement. Hemline made profit of how much?
1 million.
1 million. So let's work in thousands, right? So that it looks nice. So Hemline make a profit of 1,000, right? And Vertex made a profit of how much? 42,000. Okay, meaning their total profit was what? 43 what? 1,000. Good. So we've gotten their total what? Profit. Good. That's my first step. Now what's step 2? We said we should determine their what? Their routine what? Profit. Okay, their routine profit. So now let's try Hemlines. Hemlines was what? Hemlines was a TV screen what? Manufacturer. Meaning the appropriate method should be transactional net margin using what? Net markup, right? Because it's manufacturer. So we use a net mark up. And we know markup is a percentage of what? Of cost. Remember? So let's go and get the average markup. Was average markup given? Did you have any average markup
Okay,
for business in the
good
market?
night.
We have to use the ones they gave us down there.
Yes. So let's go and check.
Right.
Did we have TV screen manufacturers? Yes, we did.
Yes.
And do we have their net markup? Yes, we did.
Yes.
But assuming the markup was not given, you can just take the net profit over the operating expenses, right? But they've already given us the net markup. So what becomes the average markup? That's 12% plus what? 11.5. They've already done the markup for us, right? And 12.5 divided by 3.
12%.
12%, right? So now that we have it, what becomes the arm's length profit? Can we find the routine profit? So markup is applied on what? It's a percentage of what? Cost. So that means that this should be what? The percentage times what? Hemline's
Excluding
cost,
the
right?
R&D, right?
Yes, excluding the R&D. R&D didn't count. So we apply to hemline's cost. We are looking at routine, so we can't add the non-routine. Do you understand? So we add hemline's total cost was what? So you go and calculate hemline's total cost. So hemline's cost was how much? So hemline's cost. So let's go and check hemline's cost. Then hemline, the total cost near saying. We had cost of purchase 16 plus manufacturing cost. So 16 plus 21 plus other expenses of 14, right? You can't add the R&D. So what do we get?
51.
Okay, 51. Yes, so 51. So in that case, that means that the routine profit for hemlines will be what? That's a 12% off the 51 million, which is 51,000, right? We are working in thousands. So what's the routine profit? 6,120, right?
Yes, sir.
Good. Now we are done with hemlines. Let's go to Vertex, right? Allocation of profit for Vertex. Who is a TV what?
TV set
Manufacturer, right? Who also resales to third parties. No be so? So it means that so far as there's a resale to third parties, we need transactional net margin by using what? Using a net margin. Remember,
Net margin.
net margin means a percentage of sales. No be so. So in that case, can we do net margin? Let's go and check the TV set manufacturers. Good. Can we get their net margin? How do we get a net margin?
Net profit message.
Yes, so that's our net profit over our sales, right? Times 100. Okay, good. So in that case, we had 3 people there. So we need the average, right? So let's try with Pale Limited. So Pale Limited, net profit was what? 8.5. Sales was 98.5. No, so for Goita, The profit was 10. Sales was 110 times 100. For Denton, you see, we just need the average margin. This was 11.5 over 121.5 times 100. So let's get all their margin. Then we get the average for it. You see how it works. So what do we get?
For Ali, you get 8.63%.
Okay, then
Yeah.
for Goita,
For Goita, you get 9.1.
then for Denton, we have what?
Denton, you get 9.46. So we can do it
Okay.
9.5.
So we need the average margin. So the average margin now becomes what? 8.63 plus 9.1 plus 9.46 divided by 3. And that gives us what?
That will give us 9.1.
So I had 9.06%.
Yes.
Okay, so now that I've gotten 9.06, what becomes a routine profit? We know that when it comes to what? Margin, it's a percentage of what? Of sales. Mewa. So in that case, we take this 9.06, this no markup margin, times this guy's sales. This Vertex. Vertex needs sales, you're saying. The sales here 170 million. So I apply this on the 170,000, and that gives us. I have 15,402. No, be so
15,402.
So this is a routine profit. Okay. So we've gotten the routine profit of both of them. So now step 3 is to what? Determine the residual what? The residual profit. So how do we get a residual profit? So first of all, what's their total profit? We knew their total profit was how much? Was 43,000 from A, right? Then we less what? The routine profit from B, right? So the routine profit that we calculated from B. So routine profit, we had hemlines who had total routine profit of 6,120. Then we have Vertex who has profit of what? 15,402. So the total profits that comes from their routine functions gives us what? 21,522. If we take it out, then we have the residual what? Profit or the non-routine contribution. So the residual profit
478.
21,478,
478.
right? So now we are done. What's the next step? Allocate the residual what? Profit. So allocation of residual what? Profit. So let's allocate the residual profits. So first of all, what are we going to do? Since there is what? Contribution to what? Unique what? To unique intangibles, right? No, be so. Was there no contribution to unique intangibles?
Yes, there was a
So those people
contribution.
should get. So those people should get something extra because they contributed
Yes.
to the uniqueness. Do you get it? In the form of what? R&D.
R&D.
Do you get it? So the unique intangibles. R&D, right? So in that case, let's allocate. So this was 23, this was 11. Okay, so let's go and allocate 23 and 11. So in that case, total R&D becomes what? 23,000 for this guy, and then 11,000 from the other guy. The 11 is not there, but when you balance it off, 170 minus 85 minus 9, when you subtract, the difference is 11. You get it? So what is it? This gives us 33,000. No, be so.
34,000.
34, sorry. So in that case, let's allocate. So for hemlines, it will be what? To be 23
Hemlines,
out of the 34
4,
times the 21,478, right? Then for Vertex, that's going to be 11 out of the 34 times the 21 4,778. And that gives us what?
For hemline, we'll get 14529.
14529. Okay, then
0.2.
for vertex.
For vertex, we'll get 6949.
6949. Okay. So now that we have this, we can now get the arm's length profit, right? So step 4. No, that's step 5, right? Arm's length profit. And we know arm's length profit is your total contribution. So your routine plus residual. Your routine plus residual, that is it. So in that case, let's see. If we have hemlines here and we have vertex here, are you getting it? What's their profit? Their routine profit was how much? This guy's routine profit was what? 6120. Mewa. And this was 15402. No be so. The non-routine or residual profit was how much?
14529.
This is 14529. And this is 6949, right? So their routine profit was how much? Their total arm's length profit will be what? 6120 plus 14529. This guy makes 2649, right?
20649.
Yeah, so this guy makes 2649. Okay. 649. And then the other guy, 15402 plus 6949.
22351.
Right? 22351. Okay, so now that we have this, the next thing we have to do is compare this to the profit that was charged. So this is the profit you should have made, but this guy only charged 1,000 to his account, and this guy charged 42 to his account. Do you remember? This guy charged 1, this guy charged 42. So this guy, has he overstated or understated profit? This should have been a arm's length profit.
Understated.
He has understated profit by what? 19,649. Mewa.
Yes.
So the transfer pricing adjustment that should have been made to his profit should have been what? We increase his profit by this. But look at this guy. Has he overstated or he has understated?
Overstated.
Overstated profit by the same 19 what? 649. Mewa. Check and see. So it's like they have adjusted the group account with the same amount twice, just so the account looks smoothened. So the commissioner will pass 19,649 to their account. So if I'm redrafting the account, what I'll do is that this guy understated profit, right? So I'll go and increase his sales by 19,649. This guy overstated profit, so I can go and increase his cost with 19,649, or you can reduce it from the revenue. 19,649, all are accepted, right? At the end of the day, you come and get 22,351 here, and this one too, you get 19. You come and get 20,649 here as a profit after you do this adjustment. So that's how we do profit splits. You see, it's very easy.
So please, can I look at the initial part of the question, please?
So should we solve another profit split so that you get used to? Or it's okay?
I'm more understanding.
Tell us someone.
People will always say, will even say, "Oh, Prof, it's okay. We are fine."
Oh, no. Yeah, no, okay.
So if you see somebody has given a service, maybe an administrative service to somebody, what method are you going to go for?
services is
Cost plus.
Cost plus, thank you.
Cost.
Cost plus. And what markup should they go with? Routine administrative services, possibly like what? It's low value add.
3 to 5%.
3 to 5%, yes. So explain the residual profit split, indicate the circumstances in which it is most appropriate, right? When is it most appropriate? No comparables, where there are no comparables, unique intangibles. I get it. And we allocate based on what? Their unique contribution, right? We first share their what? Routine profit, then we come and share their non-routine profit. Do you get it? So, I mean, this is how these things work. So you should just know how and when the same features we're talking about, that's what you use to determine the method that should be used. Do you get it? Yeah, any big deal. Oh, this question is the same. I want the one that camel question that we saw at the top there. They brought another one. I get it. This one is still the same thing. You see, it's like medic diagnostic and way. You see, you get the total profit. Then you basic profit for the routine function. You share the routine profit. Then you get the residual profit. Then you split according to the R&D. Then you get the total attributable profit. Do you get it? Do you get it?
Yes, sir.
But there's a question I'm looking for, the camel and turbo question. It's already been passed down for 18 generations and at least the 19th. It's worth a fortune, that's no exaggeration. My father was alive, treasured it. I will definitely protect these balance belongings. There's a time. You see, it's the same question we looked at, but now look at how they've changed it. So this one came in August 2022, question 5B. Now, Tobo is a manufacturing multinational company resident in the Netherlands, manufacturing television sets, and they introduced a new model, high-tech VT. You see, it's just the same as the first question we saw. But here, look at what changes. The technology used to develop the high-tech VT has features that reduce the radiation from the TV screen by 90%. This new technology is available worldwide. There are other manufacturers springing up in Africa that have also developed similar technology for what? Other television sets to suit African market, but are of a lower grade compared to what? The high-tech VT type. You see, there are new people springing up where? Did they say Netherlands or they said Africa?
Africa.
Africa. So if you go, the ones they give you, you choose Africa, not Netherlands. Do you get it? Because we don't have people in Netherlands who are doing this. So they'll give you so many. So they want you to pay attention to the details. Tobo owns several subsidiaries across the globe, including Camel, who is resident in Ghana. Now, Camel now distributes the high-tech VT in Ghana and has what? 57% market share. So who does the distribution? Camel. But Tobo just manufactures. Do you get it? So Camel also contributed to the development of the new model high-tech. And the other distributors of similar TV sets, but of low grade in Ghana, who also buy from other manufacturers in Europe and what? Africa. Can you see that? But we also have what? Other distributors in Ghana, right? Who also buy from other manufacturers in Europe and Africa. So this one was Ghana. So now we can see their financial statement. Can you see that? So their total profit was what? 27,029. This you added, that becomes your total profit. So who was the screen manufacturer and who was the distributor?
Tobo was the
Tobo manufacturer, Camel distributor.
Tobo manufacturer, Camel is distributor. So for Tobo, what are we looking for? Are we looking for net markup or net margin?
Markup.
Yeah, so this guy we use markup, right? Because he's a manufacturer. And manufacturer, are we looking at Netherlands, Ghana, or Africa?
Netherlands. Hey,
Netherlands.
No,
yeah,
he's in
Netherlands.
Netherlands, but they said more people are springing up in Africa.
That's what I come out of.
They said that this technology is not available worldwide. There are other manufacturers springing up in Africa, not Netherlands. So if other manufacturers are springing up in Africa and your examiner has given you this data, which one are you looking for? Africa. Because they didn't say they are springing up in Europe or Ghana. They said in Africa. So you go with what?
Africa.
Africa. 45%. Then this guy too, they said the other distributors of similar TV set but of low grade in Ghana. So net profit margin for distributors will use what? Ghana.
Okay.
20%. So net markup will just what? Take the total cost, not so, of this guy. So what is Tobo's total cost? We'll just say the direct cost plus the indirect cost, operation and administration. That becomes its only cost, right? Then we apply the what? The first is their total profit. So what becomes the total profit?
But
What becomes
Prof,
the
are we
total
supposed
profit?
to add the intangibles to it? The intangible
No, I
cost.
said the intangible is the unique intangible asset. You can never add it to it. So what's our total profit? 27029 plus what? 1243. Okay. So when you add, what do you get? That's our total profit. 28.
28,272.
Okay, so we have this. The next thing is what? Get our routine profit. Maybe.
Routine profit, yes.
Okay. So first of all, let's get forward. Tobo, right?
Tobo.
Tobo, we are going with net what? Tobo is a manufacturer, so we are going to
Net
with net
markup.
net markup. Where? In
In
Africa.
Africa.
In Africa.
So that was what? 45%.
45%.
So in that case, we know that net markup is applied on what?
On cost.
The routine profit is
45%.
net markup times what? Times cost. So let's get the cost of Tobo. So the cost of Tobo is what? He had direct cost of 22,080 plus what? Operating and administration of 51111. 22,080 plus 5.
27,191.
Yeah, so that's 27,191. So in that case, what's the routine profit? That's taking what? Our 45% off 27,191. And that's how much? 12236. Okay, so that is it, right? Then we come to who? Camel, right? Camel is a distributor. No be so. So distribution, there's a sales there. So far as there's a sales, what do we do? Net margin. No be so. But we are going to use net margin. Is it Africa, Europe, Netherlands, or Ghana? Net margin where?
Yes.
Africa, Europe, or Ghana?
Ghana.
Ghana. Yes, they said other distributors are in Ghana. And in Ghana, net margin was what? 30. No, 20%, sorry.
20%.
So we use 20% on the sales, right? Good. So what's this guy's sales? Comes 20% of his sales of 22,500, which is how much? 4,500, right?
4,500, yeah.
Good. Okay, now that you have that 4,500, what you are going to do is that you now have their way. So let's get their what? Residual profit, right?
Residual profit, yes.
So residual profit, and residual profit is getting your total profit minus what? The routine profit. So their total profit was actually what? So get the total profit. So their total profit was 28,272, right? So we get our 28,272.
72.
Then we less the routine profit that we
Yeah,
had. So Tobo had what? So Tobo's routine profit was 12,236, right? 12,236. Then this one, Camel 45. If we add the two,
4,500.
what do we have?
16,736.
16,736. So we take out this 16,736 from it. And what do we have?
11,536.
11,536, right? So that now becomes the non-routine profit. So this is the same as the residual or non-routine. Okay, so sometimes the question will say non-routine profit is the same as residual non-routine contribution. Do you get it? So now the next thing will be to what? Allocate, right? Using the what? The unique intangible.
Yeah.
So in that case, the total contribution to intangible was what? 980 and 11,500, right? So total intangible cost, that was 980 and what? 11,500. Can you see that? So that gives us what? 12,480.
True.
Please, so if you are sharing, what does it become? So for Tobo, we'll get what? 980 out of the 12,480 times 11,536. No, be so.
905.9.
So let's make it 906. Then for Camel, that's 11,500 out of the 12,480 times 11,536.
10,630.
Is that?
10,630.
Do you get it? So now you've shared. So that means if you want their profits, right? So if I have Tobo here, I have Tobo here, and I have what? Camel here. I get it. Their total profit becomes what? Their routine profit. And then what? Their residual or non-routine profit, which is 906 and then 10,630. So let's go for their routine profit. That's 1236. That's 12,236. And then the other one is what? 45. So if you add this, becomes their what? Their arm's length profit. $13,142. Then we have 45 plus 10,630. That's 15,130, right? Now compared to the profits that they made, that's their charged profits. This guy made profit of 27,029. This guy made profit of 1,243, right? So the difference now gives us what? The transfer pricing adjustment that should be passed to their profits. $13,887. Well, the same 13,887, right? Same. But then one of them has understated profit, which is this guy, right? He has understated profit. So we are going to add 13,887 back to his profits. and this guy has overstated profit. So we are going to take out 13,887 from his profit. So this is a primary adjustment. This is a what? A corresponding what? Adjustment. You get the idea?
Yes, sir.
Is this thing difficult?
Huh.
Yapon. Please go and look at how to prepare transfer pricing report, TP report. It's very easy. It's just reading. Yes. Okay, and look at the advantages and disadvantages of the arm's length method, right? Of the arm's length standard. Okay, then look at what global formulary apportionment means. Okay, apart from that, we have done everything in transfer pricing. Okay. All right, so I'll see you tomorrow evening. And tomorrow evening, what am I doing? I'm doing passive income. PE, I already sent you a video on PE. I'll do passive income. I'll do pillar 1, pillar 2. So passive income, I mean article 6, 10, 11, 12, 12A. Now, last year they brought 12B. I know most of you have not heard it before. I'll teach you article 12B. I'm going to teach you article 13, article 18, pensions, article 19, government service. Okay. Then I'll teach you 21. So these ones. Then that's what I will mostly focus on, passive income, together with anti-avoidance. So we'll talk a bit about the anti-avoidance rules. And then I am going to talk about what? Residents. Residents, I already sent you a video, right? But I'll talk about residents connected articles, like Article 15 and Article 17, artists and sportsmen, right? Then Article 8. Okay. No, Articles 4 is the resident itself. I said that one, I sent you a video on it. So I'm only going to talk about the articles associated with it. So 15, 17, or 18. So this one, it depends on how shifted it is. So 15, 17, or 18. Then Article 8, and then
20.
or 7. And then there are teachers, and then this one, they don't have a home.
20.
20 is for student. This one, it doesn't have a home. It can be any article. So these are the things I'll do tomorrow.
Yes.
At least now my idea, and yes, sir. Yeah, the rest you go and read them. So these are at least me doing these articles. I know that you stand a chance of passing. Because I can't do 100% of the syllabus. Even though I can do it, I will just not do it. It's not fair. So I've literally given, as of now, you've done more than 60% of the syllabus. It's just this thing that I have to do tomorrow, and then I'll break the articles down to class 1 for you. But how was transfer pricing? Easy, right? Yeah, it's very easy.
helpful. Thank you.
We've made it look less intimidating.
Nothing is intimidating. Oh. The
So,
courses, they are
if you
very
don't
easy.
know, but now we know. Now you've taught us, so we know.
That's what I'm saying. The courses are not difficult. You just need the right guidance. That is all. All right. So if you have any questions, you can ask. If not, we can call it a night. Let me go and stretch myself. And
Prof.
Thank you very much.
Oh, please, tomorrow, is it possible to meet early so that we
No,
can have enough
you're
time in
not the
the
only people writing. No, I'm also meeting my tax practice and administration students too.
Oh, okay.
And those who are writing strategy and governance at the professional level. So it's not only you people. So I have to meet all my other people too. That's why I put you guys in the evening. I've even put giving you the special slot.
Thank you.
All right.
Thank you, sir.
Lord be with you.
And be with you too.
People who were running away from transfer pricing, same way new.